car, of course, its value is going to fall. Okay, and then non-current assets. This we have discussed last time as well, like in chapter 9, chapter 8. That non-current assets are assets which are long-term assets. Okay, we don't buy them to sell them, we buy them to use them. Okay, all right. So depreciation is an estimate of the loss in value of a non-current asset over its expected working life. Expected because we can't really know, we can't really like say for sure that this asset is going to work for these many years, right? So yeah, that's why expected. And remember, the word estimate is a keyword here. You get 1 mark for saying that word. So like, in your definition,
I saw
you
your
write
screen is not shared.
oh, okay. Thank you for letting me know about that. Like, really, thank you for letting me know about that. There we go. Hopefully, you guys can see it now. Mhm. Well, I didn't know, guys. That's the thing. I can't see the chat because like the internet on my laptop is not connected and stuff. So that's kind of sad. Oh, well, anyways, so yeah, if somebody could become the speaker and then like let me know if there's something going on. Still, where did you get an online copy of the accounting book? I got it. I actually forgot where I got it, but then whenever I got it, I like save it to my drive, and that's why I have it here. Okay, anyways, I can probably share it later. For now, let's just continue. Can somebody become the speaker? Okay, I don't know. Okay, whatever. Anyways, okay, good luck. All right, most of the non-current asset lose value over a period of time, and if the accounting records will show the asset at the cost price instead of the new value, it's kind of overstating your assets. Okay, so that's misleading information, and that's against prudence. You don't want that. So you need to record an estimate of the loss in the value of the asset, and again, you can only show an estimate by using depreciation because you can't really know the exact amount of the value of the asset because that's only going to be known when you go to sell the asset. And we're not doing that when we're using the asset, right? We only do that when we actually want to dispose of the asset or when we don't need it anymore. Well, okay, I don't think no need for speaker because I'm keeping the chat open like this, which is kind of not the best thing to do, but there's not really another choice. Okay, and then we already know that purchasing a non-current asset is capital expenditure, and that's why it's gonna be recorded as a non-current asset, like simple, right? Anyways, the cost of a non-current asset is not an expense. It's so we already know that. Capital expenditure fine. So like this is just telling you that when you buy an asset, you do not record it as an expense in the income statement. You record it as a purchase and you record it as a non-current asset, and you only record depreciation as the expense. Okay, and that's something you record in the income statement, of course, and that's the matching principle. You know. All right. The principle of prudence is also applied in the statement of financial position because current assets are recorded at their actual value, their net book value. Okay, now we have a bunch of causes for depreciation. Like if the value of an asset is falling, there is one a common reason that's physical deterioration. So, for example, if I buy a phone and then I throw it here and there, and then next day I try to sell the phone, of course, the value won't be the same, and I'm gonna have a cheaper price. So that's just using the asset. And then there's economic reasons. So, for example, if you buy an AI model, if you bought it a year ago and you try to sell it today or something, it's gonna be no use because it's just so outdated. Nobody really wants it. Passage of time, if you buy an iPhone 5 and then you sell it after 13 years, nobody really wants it because like who cares? There's iPhone 17. Okay, and then depletion. This is like when the value is taken out from something. Okay, so this is like this is usually for land and wells and mines and that kind of stuff. where normally the land would maybe cost 100,000, let's say. Okay. And then if you make a mine there and then take out every single resource that land has, the land is kind of useless now, right? Because you can do nothing there. So that land, the value of that land is going to reduce. Okay, now we have three methods for calculating depreciation. We have the straight line method, and we have the reducing balance method, and we have the what's it? The what's the third one? Revaluation, right? Where is it? Revaluation method. Okay. And all of these are pretty simple. I would say the most technical one is reducing balance method. That's where some people struggle, but they're all simple. All right, we're gonna go through them. There are several methods. Fine. Should be the one which spreads the cost as fairly as possible. And then there's like different assets. You're going to use different methods. Okay, these are the questions you consider when you're choosing which method to use. Like this is the kind of thing they could probably ask in an MCQ. And then there's three methods. We already discussed this. Okay, straight line method. This is where the value of depreciation, okay, the amount of depreciation is going to be same every year. All right. And then residual value, sorry, reducing balance method. This is where the percentage of depreciation will be same every year. And then revaluation method, this is where you just use your brain and then revalue things and the difference is the depreciation. All right. Okay, so the straight line method has a formula. You have the cost of the asset over the number of expected years you're going to use the asset. So, for example, if I buy a car for $100,000 and I think that it's going to work for 5 years, like I just think that I'll sell it after 5 years, then the depreciation would be 100,000 divided by 5, 20,000 a year. Okay. There's another formula for this. This is the cost of the asset minus the residual value or the scrap value or the salvage value as well. These are the three terms they use. But mostly for our syllabus, I think it's just going to be residual value or scrap value. So this basically means that you're gonna remove that value from the asset. If the question has given you the residual value, then you subtract it. If the question does not have anything as the residual value, then you just take the cost over the number of expected years of use. All right. And yeah, as you can see, as simple as that, 25,000 divided by 4 years, that's your depreciation. The problem is not really with calculating the depreciation. It's usually with how to record it, okay? Like the place where students struggle. But it's all simple. Trust me, it's just trust the process, all right? Okay, reducing balance method of depreciation. This is where the same percentage is applied every single year. So if I tell you depreciation is going to be 20% every year, that means that in the first year you buy the asset, okay, and you charge 20% depreciation. Let's just calculate how much that would be. 100,000, let's say, okay? And I have 20% depreciation. So like times 80%. Now it's 80,000 times 80%. Now it's 64,000. You see the depreciation is not 20,000. Now it's 16,000. And now it's going to reduce even more. Okay. So in this method of depreciation, in the reducing balance method of depreciation, the first year the depreciation is the highest, and then the depreciation amount reduces. Okay, just as the name says, the reducing balance method. So like the amount of depreciation is going to reduce every year, but the percentage will be the same. Okay. So of course, if you calculate depreciation, if you charge depreciation on an asset, its cost will reduce, and then if you charge depreciation on that cost, its value will the depreciation will reduce. It's not going to be as much as it was in the previous years. You get me? All right. Any questions so far? I don't think so. Okay. At the end of the first year, the depreciation. Okay, fine, fine. All right. This is how you do it. You start with the cost of the asset. You calculate the depreciation, 40% in our case. Okay. You're gonna subtract the depreciation. Now, this is the book value of the asset, like the actual value of the asset. I will not do past papers today, but I can maybe do them later. I don't know. Maybe I can do them in two sheets. I could do things. Okay, anyways. So this is the book value, and then you do 40% on the 15,000, and you get the depreciation, and then you subtract this, and you get the book value again, and you just keep repeating this, okay? So as you can see, the amount of depreciation is reducing. At first it was 10,000, then it became 6,000, then 3,600, then 2,100. So, this is the reducing balance method, all right? It's easy to calculate, right? There's nothing crazy. It's just the same percentage. You just put the percentage on the cost, and boom, you get it on the book value, sorry, not the cost. So yeah, hopefully this is clear. And then we have the revaluation method. So let's say I have a uh, bunch of pencils and stationery and paper and all of that stuff. Okay, this is where we use the revaluation method, like screwdrivers and stuff. I don't really need to calculate depreciation on a screwdriver using a reducing balance method or something, right? Because it doesn't really matter. So what we do is we take the total of all of these, small assets, small items and stuff, and then we estimate their new value at the end of the year. And then the difference between their old value and the new value is the depreciation. Okay. Let's look at what the textbook has to say about this. This method is used where it's not practical or it's difficult to keep detailed records of certain types of non-current assets. So, for example, like if it's a very small asset, like if it's a pencil, you don't really, it's not practical to, you know, record the depreciation on it. Or if it's something that, like for example, a screwdriver or something, you can't really tell how much the value has reduced. So it's kind of difficult, but it's not like it won't have any depreciation at all. Okay. Yep. So the examples of this are like equipment, packing cases, loose tools, like random stuff and stuff. Okay, where the opening and closing value of a non-current asset are compared and to determine the depreciation for the year. So let's just say that they've given us the opening value, they've given us the closing value, opening minus closing, that's the depreciation. Boom. So easy, right? Okay, now the fun part, recording depreciation in the ledger. Before we start this, a 30 seconds short break so I can drink some milk. All right. Any questions on the three methods of depreciation or the definition of depreciation? Nothing. Then let's quickly move on to this. And I think since it's kind of a wait, how many of you struggle with depreciation? One, two, three, four, five, six, seven, eight, nine. Yeah. How many of you guys struggle with depreciation? Not me. So like if even one of you struggles with depreciation, I can do a past paper question. I can like try to quickly do a past paper question, I guess. Okay, yeah, one of you does, of course. All right, recording depreciation in the ledger. Then we kind of quickly skim through this, and then we're gonna go to a past paper. Hopefully, we can do it quickly. Hopefully. Okay, recording depreciation using the straight line method and reducing balance method. So first of all, I want to make a few things clear. I want to kind of explain in my own way before we go to the textbook way, because the textbook is probably gonna make things more, I don't know, difficult. That's what the textbook likes to do. Let's create a blank page. All right, let's write mostly the entries for motor vehicles and disposal. All right, I got you. So yeah, let's go. We're gonna have depreciation here. Depreciation, as you know, is the reduction in the value of a non-current asset, right? Okay. Now, when you're making the balance sheet, we have to write the cost of the asset. We have to subtract accumulated depreciation. What is accumulated depreciation? That's the total depreciation you have charged on your asset up to today. Okay. So if I ask you guys to find the accumulated depreciation for this, can somebody tell me how to find it and what the value will be? Anybody? Actually, I want it to be you. Can you tell what the accumulated depreciation would be? PJXP, are you there? No, let him answer, or her, or them. What's the accumulated depreciation, bro? You have 3 seconds. Start typing. Three, two, one. Yep. Can anybody else answer? Excuse me, what? You know what I'm asking? That's a completely different chapter. How did you even get there? I'm asking how to find the accumulated depreciation for this asset. Cost minus net book value. So that's the depreciation for 1 year. How about accumulated depreciation, the depreciation for every year? You just take the depreciation for 1 year, for the second year, for the third year, for the fourth year, you add them up, And that's the total depreciation that has been charged on the asset up to today, right? So in the first year, I charged 10,000. In the second year, I charged 6,000. Third year, 3,600. And fourth year, 2,610. So this is the total depreciation I have charged on my asset up till today, right? So this is what you call accumulated depreciation, okay? Now, uh, now like when we're recording things in the ledger, we of course don't have them as easy or as simple as this. It's kind of more different, right? You don't have everything like this in your ledgers. We have debits and credits, and we have different accounts for different things, right? So we have an accumulated depreciation account. This is what it looks like. So it's called the provision for depreciation account, and the latest balance is what tells you the accumulated depreciation. Okay, so we can see that 21760. Why? What did I do? Did I do something wrong when calculating this? 16,000, 19,600, 19,600 plus 2160, 21760. Yeah, okay, 21760. I don't know what I did before, but okay, anyways. So this, as you can see, 21760, the balance BD is the total depreciation. So when you have this account, it's easy to find the total depreciation. You don't have to really manually calculate it every time. The latest balance is the accumulated depreciation. So this is the value from the provision for depreciation account that we use in our balance sheet when we're calculating the net book value. Okay, so you do cost minus accumulated depreciation, and then that's the net book value, which is your final value, which you use, to calculate the total value of the assets and stuff. All right, so that's one account. We have the provision for depreciation account. This tells us the total depreciation charged, and this is where we transfer the depreciation expense to the income statement and stuff, right? Then we have the depreciation account, the motor vehicles account, the asset account itself. Okay, and we all know about asset accounts. We all know how to make an asset account, and we all also know that the debit side of an asset account is like, if you debit the asset account, it's going to increase the value of the asset, and if you credit the asset account, it's going to decrease the value of the asset, right? But like you could ask that if I want to reduce the value of the asset, I could just directly, credit the asset account. So for example, let's say I have motor vehicles, maybe a car, okay, whatever. And I have a car costing 40,000. Now I want to charge depreciation on this 10,000. We know that debiting the motor asset account is going to increase the value, and crediting the asset account is going to decrease the value. So if I want to decrease the value of the asset, I want to charge depreciation. I can just do 10,000 here. Why do all of this complicated stuff and make another account and stuff? It's kind of unnecessary. Does anybody have to comment on this? Does anybody think this is correct? Like, is this logical? Why do we not just do this instead? I guess nobody's answering. Okay, so basically, let's just say that 40,000 is one car. Okay, like, let's just draw an image of our car. If you say that 10,000 from the car is gone, it would mean that like this much of the car is gone. That's not true. Okay, the value of the car is changed, but the car is not actually gone. Okay, so that's why we to show the reduction in the value, in the accounting value of the car, we have a different account, because this thing only has the cost of the asset. Okay, this only deals with the cost of the asset. All right, so yep, we have this account. We're gonna start with balance PD. This is, by the way, a contra asset account. So it's the complete opposite of the asset account. And the asset account debit side increases the asset. So here the this is meant for reduction in the asset account. Okay, so here debit side decreases the asset, and credit side. Wait, what did I click it? Wait a minute. Like, this is a credit positive account. Okay, when your depreciation increases, you're gonna have to credit this account. So the more depreciation you have, you're going to credit this account, and then you're going to write income statement because you're transferring the expense to the income statement. I feel like I'm missing something. Okay, to be honest, I think I'm just going to check with this. So we discussed that there's an asset account where, the asset account itself, and then you have the cost of calculating the depreciation. This is where you get the accumulated depreciation. The asset account will always have a debit balance. Assets have a debit balance, and the provision for depreciation is the opposite of the asset account, and it has a credit balance, like we discussed. It's credit positive. The main balance or the balance BD is going to be on the credit side. And then this is just an example question for us. The asset is purchased. When you purchase an asset, can somebody tell me how you will record purchasing a motor vehicle for cash, 200,000, right? So if I buy a car, 200,000, how do I record it in my accounting records? What do I debit and what do I credit? 200,000 motor vehicles on cash. Can anybody answer? It's just quite simple. Please don't get it wrong. Go try. Why did you stop typing? Okay, well, I guess I'll just say it myself. So, since your asset is increasing, your motor vehicle is increasing, you're going to debit motor vehicles, and your cash is reducing, you're going to credit your cash. That is because both of these are assets, and when assets increase, you debit their account, and when they decrease, you credit their account. Another way to understand it or look at it is that you credit the giver and you debit the receiver. Cash is giving money, and motor vehicle account is receiving the value. You're receiving a car in your motor vehicle account. Okay. So you debit the asset account with the cash book or with the supplier's account with the cost price, of course, with 200,000 because that's how much it cost us to buy the asset, right? That's how much we paid. Okay. And then at the end of the year, when you have your expense, we discussed the T account of the income statement, right? We discussed that on the debit side, it's going to be anything that decreases the profit, and the credit side is going to be anything that increases the profit. Depreciation is an expense, okay? It's a non-monetary expense, which means that it is an expense. It's going to be recorded as an expense, but nobody gives or pays money for depreciation, all right? So it's a non-monetary expense. It's just an estimated loss in the value of the asset. And since it's an expense, it's going to reduce the profit, and that means that it's going to be debited to the income statement. So you're going to have depreciation on the debit side. Is that correct? Now, if you have depreciation on the debit side of the income statement, if the income statement is being debited, then the depreciation account is going to be, it's going to be what? Credited. Yes, with what? What detail do I write? If income statement was debited with depreciation, exactly. So the depreciation account gets debited with the income statement. Why? Because the income statement depreciation account gets credited with the income statement because the income statement is being debited with depreciation. Okay, well, why is income statement being debited with depreciation in the first place? Because depreciation is an expense and it reduces the profit, and anything that reduces the profit comes on the debit side. Okay, does that make sense? And if you want to know why anything that reduces the profit comes on the debit side, well, that's because capital is credit positive and profit is, increases capital. So it's also credit positive. So yeah, there we go. Okay, anyways, that's the first entry. Understood. The second part is balance the provision for depreciation account and carry down as a credit balance. So every time, of course, you want to know your accumulated depreciation, right? So let's just say we start in the first year, we record income statement on the credit side. We just did that, right? We have depreciation account, we have income statement. Now, at the end of the year, we can't just leave an account like this, right? We need to balance it. Our accounts in accounting, you have to balance your ledger accounts. So how do we balance it? We use balance CD. We carry the balance down to the next year, okay? And we just total this. And the next year we have balance BD. By the way, for your exams, write balance completely. Don't just write BAL. It's a short form. They might do something crazy. Just don't take the risk, okay? And balance BD is going to be the same amount as balance CD. Now, this balance BD over here tells you the total depreciation charged up to date. So total depreciation charged till today, okay? And let's say there's another, the next year, there's another one. You charge depreciation again. So how will you record it? Again, in the income statement, you're going to debit the income statement with depreciation. And that means you're going to credit the depreciation account with income statement. So this thing keeps repeating. That's the entire account. Boom. It's going to be BD and then income statement and then CD and then BD income statement. You can see that it's completely like repeating. Okay. So you just have to understand this concept. And we have understood that. we know that the depreciation account is going to be credited. We know that the income statement is going to be debited. We know the reason why. And also another reason to understand why the depreciation account is being credited with the income statement to show the reduction in value is because it's a contra asset account. It's the opposite of the asset account, right? The asset account has a debit balance. Of course, we know that asset accounts have a positive debit balance. This is the opposite of the asset account. This is trying to show the reduction in the value of the asset account. So of course, it's going to be like the credit side is going to be positive. So if you record anything on the credit side, it means that you're reducing the value of the assets. Okay. So at this point, at July 1st, 2007, we have reduced the value of our asset, which was originally 25,000, by 21,760. Okay, that's the accumulated depreciation, total depreciation. Okay, balance the asset account if there have been any transactions during the year and carry down as a debit balance. Of course, you also have to balance your asset account. You have to balance every single account. So these two are kind of obvious, and this is where the fun was, and we have understood this. So let's move on to the next part. Now, this was like quite easy to calculate and stuff. The main, like in IGCSE, in our questions in the exam, they're not going to give you something as straightforward as this. What's the scenario over here? You can see that on 1 July and the year ends on 30 June. So they have given you the machinery or the asset was purchased at the first day of the year, so the depreciation is charged for the entire year. But that's not always the case. Sometimes you purchase the asset in the middle of the year, okay? And for that reason, you're gonna have to calculate depreciation for half a year, or maybe as the question will say that there is no depreciation in the first year, or maybe the question will say that there's a full depreciation in the first year, and then after that you have to calculate depreciation for half a year. So this is the concept behind depreciation. Other than that, the concept remains the same. Okay, the only thing that changes is how you calculate depreciation. So, for example, instead of multiplying it with 12 months for the entire year, you're gonna multiply it with like maybe 6 out of 12 months, half a year, or maybe whatever the number of months. Okay, we like come to this part when we do the past papers. And as you can see, this is just us buying asset, buying more asset, and then balancing and balancing. Okay. And over here we have depreciation charged for one asset and for the second asset. And this is the total value. Then again, balancing, balancing. Easy, right? Okay, and then you have the one second, ignore the date of purchase when calculating depreciation. Yep, a whole year's depreciation can also be charged. It's up to the business. If you're the owner of the business, you decide whatever you want to do. Okay, nobody's gonna stop you. Cool, right? That's what you should run a business. Anyways, recording depreciation using the revaluation method, it's pretty much the same thing. Okay, the cost of the asset. Oh, what? No way. The cost of the asset and the depreciation are recorded in the same account. That's kind of, I never, no, surprising. Anyways, during the year when the asset is purchased, you're gonna debit the asset account like normal and credit the cash like normal. You just purchase any asset, and we already discussed this entry, so let's not really ponder over it. And then at the end of the account, at the end of the year, you're gonna credit the asset account, balance the asset account basically. So like the value is 25,000, you're gonna balance it, and this is the closing balance is going to be given to you by the question. This is the opening balance also going to be given to you by the question. And then whatever is remaining, as we discussed earlier, the difference between the closing balance and the opening balance is going to be the depreciation. Okay. So yep, as you can see, it's not going to balance until you record the depreciation. And there we go, we have it. Easy to find, right? Okay, so that is the depreciation, and you're going to transfer depreciation to the income statement. If you wrote depreciation here, what does it mean? Oh my God. If you wrote depreciation here, it means that you're referring to the provision for depreciation account. That's not exactly what we want, right? Because that's a different account. An income statement is a different account. Income statement is where we record the expense. By the way, it doesn't matter if it's a fixtures account or if it's anything. You have to look at this as non-current asset account, okay? It can be fixtures, it can be motor vehicles, it can be anything. Look here, it's motor vehicles this place. And the only difference is the method. The asset doesn't matter. It's all the same. Also, income statement comes under balance CD. In this case, yes, for revaluation, yes, because like it doesn't matter where you put it, to be honest. You can put it above here, and then you can put balance CD down. We only put balance CD here because like the textbook only put balance CD here to help us, understand the calculation that you do 25,000 minus 20,500 because this is given to us by the question, right? And then the remaining balance is the income statement. Balance down. Okay. So, yep, I'm hoping that all of this makes sense because this is the part where people struggle, like, recording it in the provision for depreciation account. But it's really simple. There's absolutely nothing here, okay? The only thing is that the income statement is there and we know why it is there. So, boom, everything's solved. Now, reporting depreciation in the financial statements. Recording depreciation in the income statement, we've already done this. It's an expense, Since the provision for depreciation account is being credited with the income statement, the income statement will be debited, and income statement being debited means that it's an expense. Honestly, I will do a practice question for depreciation, but I'm not planning to do a practice question for everything because, it's taking a lot of time, and I don't really have a lot of time. You know what I mean? Like we started 45 minutes late just because my mic was not working or something. It is recorded, yes, and they're gonna upload it on their YouTube channel as well. Hopefully both sessions. But I prefer, people attend it themselves because you can ask questions when you're attending and you cannot ask questions when you're watching the recording. All right, let's continue. Recording depreciation in the income statement. Where is it? Fine, fine. The depreciation is a non-monetary expense. It's going to be shown after the monetary expenses in the income statement. So that's why, when you open the mark schemes for any depreciation question, you're going to see depreciation is always the last expense. Okay. And this is the logic behind it, by the way. All right. So even in your exam, it's good practice to record depreciation as the last expense. Okay. And this is a fine detail to know, but it doesn't really matter since we're not doing manufacturing accounts yet. And once we do it, we're gonna, look at it. Recording depreciation in the statement of financial position. We already know this part. You just take the asset. Where is it? Yeah, you take the asset, you cost less the accumulated depreciation, which is the total depreciation, and then you get your net book value. So yeah, this part is really simple. Expense as a depreciation, that's it. Like, there's literally nothing here. So I don't know why people struggle with this chapter, though I kind of do because I used to struggle with it as well. All right. What does this say? One of the notes will indicate the depreciation fine. It's gonna appear as an expense and as in the statement of financial position as accumulated depreciation. And yeah, so easy, right? Okay, now we get to the further fun part. This is disposal of the non-current assets. Will you do past paper, please? Fine. Can you guys give me a question or should I decide myself? Give me a question for depreciation or do I decide it myself? If I decided it's going to be from here, by the way, before we start disposal, let me just select the question we might be doing. If it's here, though I don't think it is. Depreciation is an easy chapter. I probably didn't put it here. Like these are the questions with which I struggled when I was a student, when I was doing my IGCSEs. And I really do recommend some of you guys or all of you guys to go and try them. They're pretty challenging. It's mostly, what's it? It's mostly like chapter 11, accruals and prepayments, because that's kind of a weird chapter. It's fun once you understand it, though. All right, disposal of non-current assets. So, when you buy a non-current asset, it's capital expenditure, fine. When you buy a non-current asset, you charge depreciation, fine. You get its original value, net book value, fine. But what if you want to sell the asset? What if the car is too old and you want to just get rid of it, right? Of course, we have to account for that too, because again, we are accountable accountants who account for everything. So there you go. We have a whole part of a chapter dedicated to this. But it's really simple. Actually simple, okay? It's very easy logic. And let's go step by step. Because the purchase of a non-current asset capital expenditure, fine, fine, fine. We already know this part, but still, it's in case you don't know, the capital expenditure is going to be recorded in the non-current asset account instead of a purchases account because it's capital expenditure. It's not meant for reselling, and purchases account is only for goods meant for reselling. Okay, when a non-current asset is sold, it is a capital receipt. We already discussed this like yesterday, and is recorded in a special account known as disposal of non-current asset account instead of the sales account because sales account again is for your normal sales activity when you sell goods, but this is not selling goods. Okay, this is selling your non-current asset. So you have a special account, and disposal of non-current asset account is that account. Okay, when you sell an asset, you have to remove it from the ledger records. Of course, like if my ledger records, if my accounts show that I have $20,000 motor vehicles at cost, right, and I sell 10,000 of them, I of course have to tell my accountant, yo, I sold $10,000 of cars. So yep, adjust that for, I don't know, adjust to your stuff, right? So the accountant is gonna remove this 10,000 value and make the total assets 10,000. But how? We are the accountant, so we have to know that. Okay. The cost of the asset and the depreciation of the asset are removed from the asset account. The cost of the asset and the depreciation on the asset are removed from the asset account and the provision for depreciation account. You see, this line kind of tells us what we have to do. Uh, the cost is removed from the asset account. The depreciation is removed from the provision for depreciation account. Fine, but where does it go? It goes to the disposal account. Okay, let's just jump to the example directly. We have the asset, okay? I bought the asset 25,000 and then I charged depreciation on it. How much? 21,760 so far, okay? That's a lot of depreciation, okay? And I sell the asset. Look at what I record in the fixtures account. I record disposal 25,000. I record the cost. Okay. Why? Because as I said earlier, in the fixtures account, in the non-current asset account, you only mention the cost. Okay. So we're gonna have disposal at cost. We're gonna record the cost of the asset because we're selling this asset completely, right? If we had like two or three fixtures or something, we're gonna have only 25,000 because that's the amount we're selling. The question is gonna tell us that, by the way. Purchase fixtures 25,000 and then fine, fine, fine. Sold all the fixtures, right? So all 25,000 gets sold. Okay, so that's it for the disposal part. And if it's why is it being credited to the non-current asset account? That's because it's reducing the value of the non-current asset account, right? When you're disposing your asset, when you're literally giving it away, it's of course going to reduce the value of your total assets. So boom, it comes on the credit side of the asset account. And then for provision for depreciation of fixtures, we talked that this is a credit positive account, meaning that on the credit side is like when you record something on the credit side, it shows an increase in depreciation, right? Right now, we want to show a decrease in depreciation. We want to take out all of the depreciation in this account. We want to take this depreciation, the total depreciation, and we want to put it to a disposal account. So what do? We're going to debit the account because that's a reduction in the depreciation. So there we go. We debit the account with the total depreciation charged on this asset. And since we only have this asset, that's the total depreciation. So we take all of it and 21760. Now, basic double entry. If the fixtures account is being credited with depreciation, then with the disposal, then disposal will be debited with fixtures. And if the depreciation account is being debited with disposal, then disposal will be credited with depreciation, as you can see. So, yep. And then you have the amount you receive from your customer for this, and we can see over here in the question. Sold all the fixtures on credit to Traders Ltd for 3,100. Now, if this was on cash, what would we do? We would simply debit cash and credit disposal, right? Debit cash because you're receiving cash, and then credit disposal because that's where the money is coming from or where the money is going and stuff. But it's not cash, it's a credit customer. He sold it on credit. So instead of cash, you just have the name of the customer. And in this case, it is Traders Ltd. And that's it. Then the balancing figure is going to be your income statement. Tell me, is this a profit or is this a loss? Can anybody tell me? Well, I guess nobody's telling me, but it's literally a loss. Why is it a loss? Because in second, I need to give the logic. I can't just say it's a loss because it's on the credit side. Oh, yeah, it is, it is, it is. It's a loss because it's on the credit side. There we go. If it's on the credit side of the disposal account, it means that it's on the debit side of the income statement, right? And what did we talk about the income statement's debit side? We said that anything that reduces the profit is on the debit side. Boom. So a loss reduces the profit, of course. If it's a profit, then it's gonna be an income. It's gonna be other income, and it's gonna be profit on selling. It's gonna be recorded, as an income, and it's gonna increase your profit. Though I had some other reasoning, like more logic, but I can't really seem to remember it right now. Okay, and that's the end of this chapter. Let's check ourselves with this quick little question. Setting purchase machinery 15,000 at the start of the year. Decided to depreciate it with a straight line method 10% per annum per year. And at the end of the year, he incorrectly charged depreciation using the reducing balance method. What was the effect for the profit for the year ended 31st December 2002? So this is the second year. All right. Let's calculate the depreciation. If you have the straight line method, then it's simply going to be 15,000 times 10%, which is 1,500 per year. And in the straight line method, it's going to be same for year one and going to be same for year two. But in the reducing balance method, it's not going to be the same. In reducing balance method, you're going to have 15,000 value of the asset times 90% because reducing 10%, you get 13,500. Fine, that's the same as the first year, same as the straight line method. Then if you do 90% again, if you subtract 10% again, then it gives you 12,150, 13,500 minus 12,150. It gives you $1,350 depreciation instead of 1,500. What was the effect of the profit for the year? So the depreciation, which was supposed to be 1,500, is now 1,350. Okay, what's the difference between 1,500 and 1,350? We have $150. Okay, is the depreciation lesser or more by 150? It's lesser than it's supposed to be by 150. And we talked that depreciation is an expense. Okay, so if you're recording an expense lesser than it is, it's increasing your profit, is it not? So what do you guys think the answer is? Is it A, B, C, D? I've pretty much literally told the answer. We've been spending, I have a question. We have spent around 50 minutes on this chapter. Should I do a past paper question on this chapter now? Anyways, the answer to this question was A, the profit is overstated by $150 because the expense was understated by $150. If you have lesser expenses, you will have more profits, right? Even though that's false less expense and that's false profit, but that's just the effect of the error. All right, let's move on to a past paper question, I guess, because because hopefully we finish it in 10 minutes. Okay, that means that I'm not gonna really go into much detail. I'll finish it in 6 minutes or something. Okay. I wanna open topicals. Oh, you can't just do everything. Your exam is in 2 days. I guess I just go here, all the way there, go here, here. All right. Yes. What's this? Depreciation is an easy chapter, right? Oh, I'm hungry now. Okay, depreciation. Do you guys want to do an old question or do you guys want to do a new question? Be careful with your answer. Old questions are weird and difficult, but new questions are weird and difficult. New? Okay, that means I'll do an old question. Let's go for 2015, October, November, paper 21. So we're going to do 0452. What was it? Winter 15, paper 21. And let's just do paper. Haha, it's so fun bullying you. All right, let's go with this. Well, remember, I'm not questioning you here. I'm just doing what's more difficult so that you guys understand better. I'm not quizzing you yet. Okay, let's just take this, put it here, then put this here. Here. Okay, let's just open this. Question number, let's check. Question number three. Let's open the mark scheme as well. This was paper 21. Question number three. Oh, this paper. I remember this paper. You guys should do this question. It's very good. I kind of scratched my head a lot for this question. Oh, this was a crazy question. I have the memories. I remember. I remember. Okay, another crazy question. You see how in old papers they had like a bunch of crazy, absolutely random theory, but for us it's kind of better. We have like five markers and stuff, so it's kind of you can at least predict what's happening. Okay, in old papers, I don't know how they kind of survived, but they did. Old people are cooler, probably. But again, all of us could do this, like two causes of depreciation. So like this is physical deterioration, and then you could say economic reasons. Maybe nobody really wants the good anymore. Straight line method is the where there is the same value of depreciation, and it's you can just state the formula as well. You can go like what's it cost of the asset over the number of years. Then the reducing balance method is where the same percentage of depreciation is charged every year. You can state the formula as well. You can go cost into rate of depreciation. Explain how depreciation is an example of the application of the prudence principle. You can say that you're not overstating your assets and when you record depreciation, because if you do not record depreciation, your assets are being recorded at a false value and their value is actually reducing and you're not reducing it, blah blah blah. One other accounting principle when charging depreciation, just say matching. That's probably the answer for every single thing. So yeah, matching principle and prudence principle. If you don't know the answer, just write them. But I'm pretty sure it's matching, by the way. Let's still check because I'm scared, right? I don't know. Yep, there we go. Matching principle. Okay. All right. Let's get to the question. We're gonna do both of these, and as you can see, just a small 12-mark question. Looks pretty easy, and then we're gonna calculate the profit or loss on the depreciation. Yep. And for this, we're basically gonna make a disposal account as well. So yeah, this is putting all of our learnings into action. And I'm gonna spend no more than 8 minutes on this because yes, because it's gonna be 1 hour after that. For 8 minutes, 16 marks. It's just 16 marks. I mean, it's kind of okay. All right, I did a 20, like I didn't do it myself, but I saw a 20-mark income statement and 20 marks statement of financial position in the same question. All right. On 1 October 2013, Natasha Salim started a business. Okay, fine, whatever. Purchased a machine paying by check on the 1st of October 2013. That's the first year, that's the start of the business. Next year, at the same, at 1st January, purchased another machine, credit. Depreciate the machines using a reducing balance method. A whole year's depreciation should be charged on the year of purchase, but no depreciation on the year of sale. Decided that the machine purchased at the start was no longer required and sold it for cash. All right. Somebody tell me how to record this. The first line purchased a machine 4,000 and paid by check. We already did this, so I want you guys to answer. Please don't take more than 10 seconds to answer. What do we debit and what do we credit? Come on, guys, 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. It's not even difficult. Are you guys even there? Am I teaching nobody? I'm literally asking you basic double entry from like chapter 2 or something. And we're in chapter 12, by the way. Okay, well, you debit your asset account because your asset is increasing. So in this case, machinery, and then you credit your bank account because your bank balance is reducing because you're paying by check, and the value is going to be 4,000 because that's how much you're paying and that's how much asset you're getting. That's literally it. And then the date is going to be the 1st of October 2013. And then next year, you're going to have the same thing. You're going to debit machinery by 6,000, and you're going to credit ABC machines instead of bank because this time you're buying on credit and not paying directly. Again, the value is going to be the same. So that's literally it for the machinery account. Okay. We have 2013 October 1. We have how much bank, right? 4,000, and then we just kind of total this CD. Just write fully. We are totaling it. We are balancing it because the year is ending, so it's kind of good practice to do that. Though the mark scheme probably would not do it, but I'm better than the mark scheme, right? Of course, of course. And then when does the year start? September, October. It starts with the 1st of October, 2014, October 1. And then we're gonna do on 1st January 2014. Wait, what? This has to be 2014. Wait, no. It's kind of weird. Oh, it's the same year. Oh my God. Not a new year. It's the same year, same financial year, 2014, October 1. We have ABC machines, and we buy 6,000 from them. And then on 1 February 2015, which is clearly a different year. So we just balance this for now. You can do CD, maybe like 10,000. Then we do BD, again 10,000. And this is going to be on 2014. This is January 1, by the way. 2014, October 1. All right. Now that's this part is done. Depreciate the machines using reducing balance method. 20%. A whole year's depreciation was to be charged in the year of purchase, but no depreciation in the year of sale. Amazing. And let's kind of start with this 20% whole year. So this is gonna be one whole year of depreciation. So we're gonna do income statement here first thing. Can somebody tell me the date of the income statement? What will you write here? What date? And to calculate this, we're gonna do. Please tell me the correct date, nicely. Okay, we're gonna do 6,000 times 20% because that's how we calculate it. We take the 2014, 2014 what? January 2014 or 45 December 2014, 32 December 2014, September 30th. Yeah, correct. You're smart, I guess. So this is gonna be 2014 September 30 because that's the last day of the first year, okay? And the depreciation on one machine, the second machine, is gonna be 1,200. We charge a full year's depreciation because the question told us. Let's just say machine 2, and then this is gonna be 1,200, and machine 1, this is gonna be 4,000 times 20%, and that's like 500, 800, okay. There we go, 800, and then this is gonna be 2,000. We just do balance CD at the same date. The date is gonna be 2014, September 30th. Okay, then you calculate the depreciation for the next year. So you're gonna do the same thing, but we sold the asset on 1 February 2015, right? So our years are basically, where is it? For September 2015. Okay. Well, our years are basically 1 October 2014 till 30 September 20. Wait, we started 2013? Yeah, we started 2013. Okay. 1 October 2013 till 30 September 2014. And then we have 1 October 2014 till 30 September 2015. Okay. So for this asset, for the asset that we're selling, okay, the machine purchased on 1 October 2013, we have charged 1 year's depreciation. We have charged depreciation for this part, and then it's the asset is sold during the second year. Okay, it's in the middle of this second year, and the question says that no depreciation. Where is it? No depreciation in the year of sale. Okay, so we do not charge depreciation on this asset again. Now we only charge depreciation on the second asset, which is gonna be 6,000 minus 1,200. So let's do that, 6,000 minus 1,200. And then we multiply this with our rate of depreciation, which is 10% in this question, right? Where is it? 10%, 20%, my bad. There we go, 20%. And this is going to be income statement now with $960 at 30 September, but 2015. All right. And then we're just going to balance this again. We're just going to do CD 960 and then total, and then we're going to do balance BG 960. One second. I forgot to bring balance BD here. First thing we do is BD 2000, then you do income statement 960, then you do CD 2960, then you total this, then you do BD for the next year, which is over here is going to be, where is it? 1 October 2015, that's the balance BD date, 2960. Okay. And yep, that's the end of this account. Now we're gonna, since we are selling this asset, by the way, guys, is it making sense? Please, like, if there's a question, let me know. I thought we weren't gonna calculate depreciation in 2015 because it's a year of disposal. Yes, it is, but it's only for one asset. Decided that the machine purchased on 1 October 2013 was no longer required, but we also purchased a machine on 1 January 2014, another machine. Okay, so we charge depreciation for that another machine. Yeah. Does no one else have questions? Like, I can't believe you guys are so smart. You're so smart. Then I don't know. Good luck with the exam, I guess. Better let me know your grades when they're out. Okay. There we go. This is done. Now, yep, since we are selling $4,000, we're disposing of this. Do we record anything in here in the machinery account? Of course we do. Since the asset is going away, we are literally disposing of it, and we're disposing of $4,000 worth of asset. We have to reduce the total value of the asset account by $4,000, and to do that, we will credit the asset account. What is causing this reduction? The disposal account is causing this reduction. Since we're disposing of the asset, the value which we're reducing from the non-current asset account is going to go to disposal. And this is all happening on 1st February 2015. So we do this, and then we do balance CD, which is going to be 6,000, and we total this, that's 10,000. This also becomes 10,000, and then we have balance PD, 6,000. This tells us that we currently have $6,000 worth of machinery in our business. Okay, like the cost of the machinery is $6,000, and we have this as $6,000 and not the depreciated value because of the historic cost principle, which tells us to record stuff at their cost value. Although in the statement of financial position we subtract depreciation, but the prudence principle matters more in this case. Well, anyways, so yeah, this is gonna be first October 2015. Okay, there we go. So this is how you do the disposal part, and I'm pretty sure you all know why we're doing the disposal part. It's because we're literally disposing of the asset, and that reduces the value of the asset. Okay, and then the total depreciation charged on the asset, where is it? On machine one is 800. So we're gonna do, before we do balance PD, we're gonna do this disposal since it's happening during the second year. This is gonna be 1 October 2014, and this is what, 30 September 2015. This is also 30 September 2015. And then here we're gonna have the same date, and we're gonna have disposal, and we're gonna have 800 because that's the total depreciation charge on machine one, and the balance CD is gonna be changed. Where is it? How it's happening? Okay. 2960 minus 800, 2160. That is our new balance CD. This becomes 2960. We're doing depreciation past paper question because some people said they want to do depreciation past paper question. Though, like, it's been 1 hour and 6 minutes. Oh my god, I can't believe I spent more than a bunch of minutes on this question. BD is gonna be 1 October 2015. This is gonna be 2160. And yep, that's the end of this part. And now we're gonna continue to our disposal account. We have received cash 2,100 mentioned by the question, and the disposal depreciation is 800 given to us from the disposal account. We're gonna have to write provision for depreciation here, by the way, since we're getting it from that account. And the cost of the asset, where we're gonna write machinery, is 4,000, and this is our disposal account. Okay, am I missing something? One, two, and three. 2,100 is the selling price. Fine. 2,900, and I think the rest is our profit. Sorry, our loss. Is this gonna be uploaded? Yes, it will. Hopefully, I have no clue what's being done. Just waiting for a new question. Brother, I won't be doing another question just to let you know. So I'm telling you guys to ask questions for a reason, okay? Because I'm literally just explaining, and since nobody's asking questions, I know that nobody's listening because there's no way nobody has questions. So please, if you have questions, ask them. I don't really have the time to repeat. We're gonna have to do 11 chapters today, and we're still on the first one, and it's been 2 hours since we were supposed to start. So that's not speed, we have to do the next chapters even faster. So please, if there's questions, ask them. Don't wait for the next question. We were supposed to start at 10. I woke up at 10. I got up and, like, I turned on my laptop and stuff at 10. But the Wi-Fi and stuff didn't work for 45 or minutes. And then we started at 10:45. No, bank reconciliation is like chapter 16 or 17, or I don't know what. It's later, don't worry. If you wanna if you wanna understand it right now and it's urgent, then you can go watch the previous session recordings. Okay, that's good. So we still have one chapter away. Yeah, we still have a chapter. Okay, well, so the income statement is gonna be what, 1,100. I think that's a loss. Let's look at our answer. Okay, let's just split screen this. I haven't done a depreciation question in probably quite a few months, but as you can see, I could do it, and that's because I understood stuff previously. So doing this wasn't really much of a challenge. So I really recommend you guys to understand stuff more than memorize it. And yeah, this is perfect. Then for this, we have 8,800 plus 1,200. We have balance BD 2,000. We have disposal 800. And we have income statement 960. And we have balance BD 2 marks for this. And there we go, 12 marks secured. And then we have the loss provision. This is the proceeds and depreciation less machinery cost. This is our loss. That's correct. Boom, there we go, 16 easy marks. It took us 18 minutes to do this question. I'm surprised it took me that long. I thought I could do it faster, but I don't know. Anyways, okay, bro. We're doing chapter 12. Yes, exactly. We are doing chapter 12, and we are done with chapter 12. I hope you guys understood it. If you did not, then that's a massive skill issue. Just joking. If you did not, then ask me any questions because once I go to the next chapter, I won't really feel like answering any questions for the previous chapter, though I probably will answer them if you ask them, but I might not, right? So, don't take the risk. Okay, I'm away 3 seconds. If anybody starts typing for any questions, three, two, one. I don't think anybody has a question, then let's move on. Did you purposely start typing after I stopped counting? Okay, okay, I understand that. Fine. Irrecoverable debts and provision for doubtful debts. Oh yeah, how about we take a 5 minutes break because we are done with one chapter. So yeah, let's take a 5 minutes break. Yep, let's get right into it. That's enough break. I think we took more than 5 minutes. I'm not really sure. Okay, irrecoverable debts and provision for doubtful debts. Okay, so irrecoverable, as the name kind of suggests, it's something you cannot really recover. And debts, as we know from before, it's basically the amount people owe us. It's kind of like your trade receivables. Okay, so irrecoverable debts, irrecoverable trade receivables, which is basically you sell goods to your customers and then they take the money. Sorry, they take the goods, they look at your face, they say, I'm going to pay you tomorrow. And then tomorrow, they're not there anymore. Okay. Boom. They went to another planet. Okay. So that is a bad debt. Okay. It's an irrecoverable debt. You can't get your money back. Just forget your money. It's gone. And then there's provision for doubtful debts, which is basically you making an estimate and kind of accounting as an accountable accountant for any possible irrecoverable debts. Okay. So you take some of your trade receivables and you go like, okay, this percent, this much percent of my trade receivables will probably be irrecoverable. So, that's kind of just put them as an expense to, keep our accounting statements and our accounting information real. Okay. So if I tell you that I have $1 million of trade receivables. Okay, so people owe me $1 million. Does that mean that I will get $1 million? Well, not everyone is as honest. Maybe you're a good person, you're gonna pay me, but maybe there's someone else who's like, ha ha ha, you think you're gonna give me goods and I'll pay you, ha ha ha, goodbye. And then like there's people like me and stuff, right? So you need to first of all, you can prevent these by being careful who you sell your goods to, or you can just sell goods on cash and not on credit, or you can, give more cash discounts so customers are literally, encouraged to pay earlier. But for some evil people, that won't work, right? So yeah, you have to sometimes take legal action, like literally take their family to court and then tell them that, I don't know. You don't have to take their family, you probably have to just take them. I don't know, I never went to court, right? Okay, so we have understood the meaning of irrecoverable debts, and we have to, of course, as accountable accountants who account for everything in accounting, we have to account for this as well. So ledger accounts is obviously involved, and then there's this thing called recovery of debts written off. So, for example, if you sold goods to me, and after 2 years you're like, hey, I don't think you're gonna pay me any money, so I'll actually write you off as an irrecoverable debt because I'm pretty confident you are never gonna pay me. Okay, so when you say that, I feel kind of bad, and I'm like, hey, actually, out of my $1 million, I'll give you like $15. Have some coffee for yourself. So this $15, you wrote my $1 million off as irrecoverable debts. Okay, like there's no way you're gonna get them back. You've recorded that as an expense. Okay, this $1 million, it hasn't become an expense. It's become irrecoverable debts for you. But then I go like, okay, I kind of feel bad, and I give you some money back, okay? So this money back which I give you is debts written, sorry, it's debts recovered, okay? You had forgotten about this money, you recorded it as an expense, but then suddenly a miracle happened and I felt like giving you money. Of course, I don't give the full amount because like I'm me, right? So like you don't when you're having debts recovered, you won't always get the full amount, but you can. Maybe the person just became rich suddenly, okay? Maybe he was bankrupt 25 years ago, but now he became rich. So yeah, that's that. All right. Then I've kind of did this, but of course we're gonna go into much detail. And I honestly want to skim through this chapter. Let's aim for 20 minutes. We're gonna finish this in 20 minutes. The recording is at 123. Let's get this done by 143. Okay. So introduction, irrecoverable debt is an amount owing to a business, which is basically, trade receivables, right? And then which will not be paid by the credit customer. So if somebody owes you money and they're not paying it, boom, irrecoverable debts. Okay. Now maybe it's because the customer disappeared, he went out of business, or he's literally unable to pay, he doesn't have money, or he's bankrupt, or he died, or whatever. Okay. If all the reasonable steps to obtain payment have failed, the debt is written off. So like you go to the customer, you go to his home, you tell him, please give me money. And even after all of the actions you've taken, he's not giving you money, or he literally does not have any money to give you. In that case, you're gonna be like, okay, bro, just goodbye. I just have to write off your debt because if you don't write it off, it's gonna say that you have this much trade receivables, but that's not true because you won't really receive that money. So you can't record it as trade receivables. You have to record it as bad debts. You have to remove it from trade receivables and charge it, record it as an expense. Okay, because prudence principle, a debt written off may be recovered if a credited customer pays some or all of the amount owed after the amount was written off. So in my example, I wrote off $1 million and then I felt guilty, I felt kind of sad, and I paid $15 back. Okay, so that's just an example. And the account of the credit customer is closed by transferring the amount written off to the irrecoverable debts account. So, for example, we know that in our credit customer's account, trade receivable account, it's an asset account. Anything on the debit side is going to increase the trade receivables, and anything on the credit side is going to decrease the trade receivables. So, if you have a debit balance over here, if I have $1 million, it means that this customer, this credit customer A, owes me $1 million. Okay, and then if he pays me money back, I'm gonna be like maybe 500K. He pays me back. Now he owes me 500. Once we do that balance CD and stuff, it's gonna be BB by the way. So now he owes me this much, fine, but he doesn't seem to be paying anymore, right? So this I will write it off as bad debts. And why will I write it on the credit side? Because I want to reduce the value he owes me. Okay, so that's why we credit the customer's account, and then you're gonna write here irrecoverable debts, and in the irrecoverable debts account, you're gonna of course debit the customer, and we will another reason to understand it is that you're debiting the irrecoverable debts account because it's an expense and expense accounts expenses are debited. So here you're going to write customer A and you're going to write 500,000. Okay. So that is how you record or how you write off an irrecoverable debt. You remove all of the value from the customer's account. And now, as you can see, the customer's account is balanced. It's closed. Okay. Now we have nothing to do with the customer. Even if the customer pays us again, we will not record it in the customer's account because it's literally closed. Okay. There's nothing to do here unless the customer buys goods again and then you open another account for the customer, you won't have anything with this account. Okay, it's done. And yep, that's the main idea. Now let's continue. Look at some detail the question the textbook has to say. At the end of the year, the total of the irrecoverable debts account is transferred to the income statement where it's regarded as an expense for the year. So we already have looked at expense accounts in chapter 11. Now let's just call it bad debts because that used to be the old name and that's kind of easier to understand. Bad debts, irrecoverable debts, both are the same thing. Irrecoverable debts is the new name. It's for the newer syllabus. Like, you guys should use irrecoverable debts. So I guess I'll just write irrecoverable debts. All right. Now we know that this is an expense and expenses, they come on the income statement, right? Now, how do they come on the income statement? You have to transfer them to the income statement, of course. If you write here customer A, customer B, your total, and then you have all of your the bad debts, and then you can also the question will sometimes give you the total directly. So it's going to be like total for the month, let's say, and maybe it's just like 200. Okay. So in the income statement, you have to put it on the debit side of the income statement, right? Because expenses reduce your profit, and anything that reduces the profit comes on the debit side of the income statement. So over here, you're going to have bad debts. If it's coming on the debit side of the income statement, it's going to come on the credit side of the irrecoverable debts account, right? So you're going to have income statement here. Another reason to understand it, another way to understand it is that if expenses are debited, and you want to kind of reduce the value of the expense account, you want to transfer it, you want to take the value from the expense account and put it somewhere else. What are you going to do? You're going to do the opposite. Instead of debiting it, you're going to credit it. So you credit it with the amount, and boom, that's how you transfer to the income statement. And this is for all expense accounts, okay? It's not just for this. So we've already done this before. I don't know why I explained in so much detail. By the way, guys, please, if there's questions, ask, okay? Because the chat's been too dead, okay? It feels like nobody's here. Okay. Yeah, it actually does feel like nobody's here. All right. Yes, certainly sad. All right, then we have done this part. The entries are similar. Credit the customer's account with the recovered account on this part. Credit done this part. Okay, and we have already understood this part. If you have an irrecoverable debt, you cannot call it an asset. You cannot call it a trade receivable because if you do, then you're overstating your assets, and that's against the principle of prudence. Okay. And we have also done this part that is going to be an expense. It's going to be including the income statement. And it's going to be, yeah, if you don't include it in the income statement, then you're overstating your profit because you're not recording all of your expenses, which is also against prudence again. Now, in case your customer pays you back, you have a irrecoverable debts recovered account. Space sum or all of the amount written off, fine. The customer account has been closed. The amount is received is debited in the cash book and credited to debts recovered account. When we had the irrecoverable debts, we debited the irrecoverable debts account because the irrecoverable debts account is an expense account, right? This is an expense account, right? And expenses are debited. But then we have a different account, which is not an expense, which is an income, and that is called the irrecoverable debts recovered. And this is going to be, of course, credit positive because it's an income. So every time your income increases, you're going to credit this account, and your income or your irrecoverable that's recovered will increase when a customer pays you back some of the money. So if first you close the customer's account. Now, if you receive money, cash or bank, right? That's the only way you can receive money. Maybe sometimes you can also receive a good. You can receive a non-current asset if you accept it. You're the owner of the business, right? So if he pays you a car instead of 40,000, you're gonna be like, fine, just give me anything. Okay, so he gives you an asset or cash or bank. You debit that because basically monetary your cash is increasing, and then instead of crediting the customer account, you're gonna credit a recoverable that's a recovered account. You're not gonna credit the customer account because the customer account is finished. We closed the customer account, so you credit the irrecoverable that's recovered account, and then same like the expense. Once you have the total, let's say it's 100, you're going to have to transfer it to the income statement, and in the income statement this will come as an income. It's going to increase your profit, and you're going to have it after gross profit as other incomes. Okay. All right, debit the cash book and credit the debts recovered account. Done this part. Debit the debts recovered account and credit the income statement. Done this part. At the end of the year, as you can see, we debit the debts recovered account and we credit the income statement. All right. So yeah, we've understood this part all. And this is just an example. And this is just the theoretical part where you have to reduce the possibility of irrecoverable debts. You have to take the possible steps you can before allowing a new credit, before like selling goods on credit to a new customer. Make sure that you have some references from other suppliers or from the bank, and make sure you have a credit limit. Like I won't sell more than $5,000 worth of goods on credit to this customer. And then you have a like this is all credit control. and then issue like reminders and month-end statement of accounts promptly. Just do them every month to kind of remind the person. And if there's anything that's been overdue for a long time, let the customer know, ask them to pay, make calls, send letters, go to their home, whatever you need to, get your money back, right? Don't supply further goods until the amount due is paid. Or if something's too bad, like he's taken $1 million and he's literally not paying, and he doesn't even have a reason to not pay. Like he has a lot of money, he's just not paying or something. But like if it's too extreme, then go take legal actions, call the police or something, go, I don't know. But if the debt is too small, then it's not really worth it. Like if you have a $10 debt, then it's not worth making a huge court case about it because that's gonna cost you more than the debt itself. Okay. And then there is invoice discounting or debt factoring. Debt factoring is basically you uh, like other companies are going to pay you lesser, and then they're going to go take the money from the customer themselves. And then invoice discounting is basically you just tell the, but I don't know what invoice discounting is. Yeah, I don't know, so I shouldn't really talk about it. But either way, they're outside the syllabus. And then you have provision for doubtful debts. As I said, it's kind of an estimate, again, keyword estimate, of the amount which a business will lose in a financial year because of possible irrecoverable debts. Okay. So this is also again prudence and matching principle. Prudence because you can't, if you have $1 million trade receivables, you can't be like all of these trade receivables are gonna be received, okay? Because it's kind of unbelievable. If you have $10 million trade receivables, it doesn't mean everybody's gonna pay. Maybe some people run away. Maybe some people go bankrupt and their businesses stop or something. So you need to keep this. And how do you understand or estimate the value of the irrecoverable debts? By the way, it's a percentage. You decided by a percentage of your total trade receivables. So you look at each individual customer's account and you go like, this guy will pay, this guy will not pay, based on what you know about the customer. And then you can experience based on the past experience. You can like, estimate based on the past experience. So like maybe I've been doing business for 10 years, and every year there's like 7% or like 7 to 9% of people who don't pay irrecoverable debt, who don't pay their accounts. So, with my experience, I can estimate that even this year 7% will not pay their accounts. You get that? Or you can check that my customer has not paid for like 6 months, so he probably won't pay. Or this customer has paid within 2 days, so he probably will pay. So using the length of time that that's have been outstanding. Like if you have a higher percent, if you have a longer, very older debt, so if it's 1 year old and the value is like 200,000, you can be like, okay, this is probably, I'm not going to receive it, or maybe I'm not going to receive like 80% of it. So you account for that. Well, these are just methods. The question will usually give you the rate themselves. You don't really have to find it yourself. You just should know this because maybe they ask it in theory or MCQs. And then to create a provision for doubtful debts, it's very similar to your provision for depreciation. The only difference is that this has a possibility of your provision for doubtful debt increasing or decreasing, and that decides whether it's going to be an income or an expense, which means that it decides whether it comes on the credit side or debit side of your provision for doubtful debts account. They don't really have a good example here. Wow, they don't really have a good example. Okay, anyways, so when you wanna create the provision for doubtful debts account, which is an expense, provision for doubtful debts is an expense. So you're gonna debit the income statement because it's an expense. The same way as depreciation, right? The same reasoning as well. I won't really explain it again. And you're gonna credit the provision for doubtful debts account. So on the provision for doubtful debts account, on the credit side, you're going to have income statement and then balance CD and then balance BD, income statement, right? But in depreciation, it was 100% sure that the income statement will always come on the credit side because depreciation is always an expense, right? It's 100%. It's like it's certain that it's an expense, and every year it will be an expense. It's not like it's going to turn to an income someday. But for provision for doubtful debts, that is possible, okay? And we're going to learn how. So, what should we do? Hmm. We have 5 more minutes, right? Looking for a good question. Okay, this will be a good example. So here we have at 31st December we created a provision for the outputs of $1,000. As you can see, you have income statement $1,000. No, I think this is from the previous question. Yeah, it's from the previous question. Anyways, it doesn't matter much. All right, so we have $1,000, and then during the year you wrote off debt, so you're going to debit your irrecoverable debts account, as you can see over here, and then at the end of the year you're going to credit the irrecoverable debts account and debit the income statement. This is basically transferring the total amount and recording it as an expense in the income statement. And then your trade receivables are 28,000. 4% of them is your what's it? Is your new provision for doubtful debts. So you take your total trade receivables and then you multiply it with 4% because you think they won't pay, but they actually did pay on time. So then you have to make a new customer account. No, then you just do bad debts recovered. You won't make a new account for them. Like if you made an estimation that they won't pay, by the way, you don't do an individual per customer estimation or something usually. You just have it as an overall amount. But if you wrote off one customer as bad debt and then he pays, you just record it as bad debts recovered. You don't really make an account again according to what we are studying. But in a real business, like maybe it's your choice, right? So maybe you don't have to follow these rules. You can just open the customer's account again. You can delete the entry you just made. If you wrote him off as a bad debt, you can just delete that entry. Like it's your choice, you know. But according to the paper or like according to the rules in the book, you have to make another account. Sorry, you have to record it as bad debts recovered. Okay, anyway, so 28,000 times 4% is not 120. 28,000 times 4%. What is the answer? It's gonna be 1,120. Is what? Did I read the question wrong? 28,000. Okay, my bad. 28,000. As you can see, it's 1,120. But we recorded only 120 over here. Why? Notice how, no, I was literally, I read the question wrong. Okay, anyways. All right. So as you can see that this is on the credit side. The income statement is on the credit side, meaning the income statement is being debited, meaning this is an expense, right? And this was the provision for doubtful debts was $1,000 before. Okay, now it's 1,120. They only record 120. That's the increase in the provision for doubtful debts. $120 is the increase. It's not the total provision. It's the increase, and then you do balance CD, and then you get to the total provision. So you see how we only record the increase or decrease, okay? So if it is an increase in the provision for doubtful debts, it's going to be an expense. If it is a decrease, then in that case, I'm surprised they don't have an example for it, to be honest. Okay, yeah, they do. Thankfully, they do. As you can see, this is 1120 carried down from the previous question. Just continue from the previous question. And the provision for doubtful debts amounted to 1120. And then 24,000 is the new trade receivables, and then 4% of this is our new depreciation. As our new total provision for doubtful debts. As you can see, this is 960, and before it was 1,120. So you want to make the balance CD 960 because the total provision for doubtful debts is 960 for this year. Okay, so you write balance CD 960, and then the balancing figure, where will it go? It's going to come on the debit side. If it comes on the debit side, it's going to be the income statement. This shows that it's an income because it's on the debit side of the provision for doubtful debts account, meaning it's on the credit side of the income statement, and anything that increases the profit is on the credit side of the income statement, which means that this is an income. So an increase in the sorry, a decrease in the provision for doubtful debts is an income, and it increases your profit, and it comes on the debit side of the provision for doubtful debts account. Meanwhile, an increase, so it increased from 1,220, 1,120. It's recorded as an expense, and it comes on the credit side of the provision for doubtful debts account. Okay, so yeah, I hope that makes sense, and I hope that's clear. And then for recording it in the income statement, it's very simple. You just have your expenses, you have your recoverable debts, your bad debts as an expense, and then you have increase in provision for doubtful debts as an expense. And then you can see that your trade receivables as well, you subtract the provision for doubtful debts because those are the estimated trade receivables that will not pay, right? So you cannot really record them as trade receivables. You have to subtract it from there. And then again in the income statement, you're gonna have to record the irrecoverable debts for the year and then the increase in the provision for doubtful debts. Notice how they don't write 1,120. They only write 120 because that's the expense, okay? And then for the when you're subtracting the total provision, you do 1,120. You remove all the provision for doubtful debts, which you get as the balance BD, okay? And then in the last question, in the last example, we have a reduction in provision for doubtful debts. This is an income, right? So you add it after your gross profit with other incomes, and yep, as you can see over here, and then you subtract the total provision for doubtful debts, which is 960, because balance BD is 960, and you subtract that from your total trade receivables, and you get there. And yes, we finished in 21 minutes instead of 20 minutes, but I think that's still a good. Let's do this question. When you maintain the provision for doubtful debts, which statements are correct? It is um, estimate of what may be lost because of irrecoverable debts. Yes, it is said to be after the answer is A. All right, we have done this chapter. Any questions, guys? Yes, we have to. That's what I was doing in the last minute. As you can see, we have expensive irrecoverable debts. It's always there. And then the provision for doubtful debts. Irrecoverable debts is an expense, so it's like, it's always going to be there. If you have any, the amount will be there if it's relating to this year, of course. And the provision for doubtful debts, it depends whether it's increasing or decreasing. Yes, it can. I mean, of course, if you never made a provision, it can be zero. But it's kind of like if you have very literary receivers, $100, and you're 100% sure that they're gonna pay, that customers will pay, then fine, you don't need to really create a provision. But then if you have a $10 million trade receivables, it's kind of obvious that not everyone will pay, so you need to have it. You need to have the provision. You just have to make the accounting records more realistic. Okay, if you believe that your $100 trade receivables will not pay, then create a provision for them as well. Okay, so yeah, that's about it. Now it's time for 1 second. Let me check if we have time left. Left 22 to 32. We have like 8 minutes left. Okay, then I think I will do some part of the chapter 14 bank reconciliation statement, and then we're going to take a 15 to 20 minutes break, and then we're going to continue after that. All right. So, introduction to bank reconciliation statement. Mm, should I do some of this or? Okay, fine. I guess I'll do till. I guess I'll just do the introduction. Okay, so you know how a bank will send you bank statements similar to the statement of account you send to your customers. Your bank statement will basically have a summary of all the bank transactions you did for the month. Okay, and it's going to tell you your bank balance as well. And it's a copy of the customer's account in the books of the bank. So in the books of the bank, and that's why it's going to have like opposite credits and debits. Okay, so for example, when you receive money, it's an asset for you, but it's a liability for the bank. Okay, because it's the opposite for the bank. And when you pay money, it's a reduction for you, but it's increasing for the bank. Okay, So yeah, this is a record of transactions as they affect the bank. When money is paid into the bank, the customer's account will be credited. When we pay money into the bank, we debit our cash book, right? Because we're increasing money, but the bank will credit your account. The bank will credit the customer's account, okay? As this is the amount owed by the bank to the customer. Because if you're like, it becomes a liability to the bank when you put money into the bank, okay? Because the bank has to eventually pay you back. You have to take your money. It's your money. It's not the bank's money. Okay, and the customer's account will be when money is taken out of the bank, the customer's account will be debited because this reduces the amount owed by the bank to the customer. So I'm pretty sure, I'm hoping that this part makes sense. A positive bank balance will be a credit balance for the bank, because if it's credit, then it means that the bank owes you money, which means that you have money in the bank. Okay, and an overdrawn balance, which is like a negative balance, it's going to be a debit balance, which means that the bank owes you money, which is good for the bank, but it's bad for you. Did I say that right? The bank owes you money. No, no, it's the opposite. Like you owe. Well, like when it's a negative balance, it's an asset for the bank. Okay. Anyways, when the entry on the bank statement are compared to those in the bank account, so like the bank statement compared to the bank account in our cash book, okay, our bank account, it will be found that everything is recorded in the opposite side, because like if something's debited for me, it's going to be credited in the bank statement. Okay, money paid into the bank is debited, and money withdrawn from the bank is credited. Meanwhile, for us, when we pay money into the bank, yeah, that's how it is. So, anyways, it's important to compare the bank statement and the bank account, which we have, our bank account, which is in the cash book, because sometimes they disagree. They're not always equal. So if they disagree, you need to tell why they disagree, okay? And that's called reconciling the bank statement and the bank account. And you have to make a bank reconciliation statement for that purpose. Now, why will the bank account and the bank statement be different? There is this timing difference, and then there is the business not recording certain things in the cash book because they literally cannot. Okay, and then there's two reasons for the timing differences. There's checks not yet presented, which is unpresented checks, also known as unpresented checks, and then there's amounts not yet credited, or also known as uncredited deposits. And this means that it is not credited to the bank statement. Okay, but this is debited to the cash book. And this means that it is not debited to the cash book, not debited to the bank statement, but it is credited to the cash book. So if it's credited to the cash book, it means that the cash book balance is lower. Okay, cash book balance is lower than the bank statement because it's credited. And here the cash book is debited, but the bank statement is not, adjusted for that. So the cash book balance here is higher because it's debited, while the bank statement is, not adjusted for that. It's not credited. Okay. And yeah, by theoretical means, these are checks that have been paid by the business and entered to the credit side of the cash book. They are credited to the cash book, but they do not appear on the bank statement. They're not debited to the bank statement. Okay. Now, why is this? It's because the bank has to, do some security checks and a lot of stuff like the banking process, the banking system. This usually takes a bunch of time for the bank, and that's why the bank does not have it in the bank statement. And then there's amounts not yet credited. These are this is stuff which we paid to the bank. So we pay to the bank. We have sorry, which have been paid into the bank and entered at the debit side of the cash book. We have debited our cash book, but they do not appear in the bank statement because it can few days, before the bank can record things in the customer's account because of all the security checks and whatever banking process they have to do. So it usually takes a bunch of time, and that's why these two exist, timing differences. Okay, can you speak slower? Oh well, I don't know. Nobody's really talking, so I'm just speaking to myself, kind of. Also, I have to kind of leave for prayers. So like we're gonna take a break here, and then we're gonna continue after around 15 to 20 minutes. And sure, I can try slowing down after that. Yeah, guess what this break is called? Anyways, see you after the break. This is the Catherine. Yeah, sure. This one. This is not for 2027 syllabus though. Okay, well, anyways. Alright, then see you guys in a bit. Alright, then I'm gonna just turn off my mic and then see you guys in a couple of minutes. Hopefully. Yo, what's up guys? I'm back and sharp on time, 1 minute early. Kind of proud of myself. Alright then. And to answer your question, Mr. Mr. Wobbly Jobbly, um, we're gonna do chapter 14 right now, bank reconciliation statements. We have covered all the way till chapter 13 so far. And is my voice and screen clear? All right. Anyways, there was no specific schedule for break times and stuff. I just left because I had to go pray, and now I'm back, and we're gonna continue. So, yep, should we start? Yes, I've got a few people, perhaps. So, maybe I share. Oh, you're here. Okay, never mind. Who else? Maybe it's lazy or something. Maybe, maybe the French guy. What happened? Okay, anyway, should we start? I told you that there is no specific schedule. I left because I had to go for prayer, and we're basically doing one chapter and then a short break of 5 minutes or something, and then continue with the next chapter. Okay, and right now we're gonna finish chapter 14 and chapter 15 as well together, I suppose, if chapter 15 is control accounts. Right now we're doing bank reconciliation statements, after which we have journal entries and errors. Okay. So we've reached till here. We discussed what unpresented checks and uncredited deposits are. Now we're going to go to things that are not recorded in the cash book, but they come in the bank statement. And we're also going to discuss why they come in the bank statement and why do we not have them in the cash book. Okay, so sometimes you don't know the things. Okay, so for example, bank charges and bank interest, you wouldn't know how much it is until the bank statement comes, because the bank decides this thing, right? So the bank decides it and tells you your expense with the bank statement, and that's why you will have to add this to your cash book once you get the bank statement. Then dishonored checks as well, for the same reason. You won't know it until you get the bank statement, so you have to adjust your cash book for it, and amounts paid directly into the bank. When one of your customers or someone paid you through a bank transfer, like directly into the bank, standing orders, credit transfer, direct debits, you wouldn't know that because the customer didn't really tell you. and you don't really have proof even if he did tell you. So you wait for the bank statement and then you record it. And then amounts paid directly by the bank to others. So if you pay by the bank, you just wait for the bank statement and then you record it. And any other differences between the two records must be investigated. There can be errors made by the business, and there can be errors made by the bank. If there's an error by the bank, you just tell the bank there's an error, and you adjust for it in your bank reconciliation statement. And these are the just a summary of it. This is below here. All right. Now, when you're making a bank reconciliation statement, let's just skip this part. What do you guys say? Let's not learn how to make a bank reconciliation statement. And then when there's a bank, oh, I forgot. I had to turn on the recording. Okay, anyways, we discussed what this is. We discussed what this is. And now for a bank reconciliation statement, how to prepare it. Let's just skip it. What do you guys say? Is it okay if we just skip it? Right? Smart, right? We're gonna save time that way. Is nobody gonna respond? Anyways, so the advantages of bank reconciliation. You have an accurate bank balance, which will be used for your statement of financial position and everywhere. That's a good thing. Then errors will be identified, and it will, help discover fraud. And you can discover uncredited deposits and unpresented checks, and you can discover dishonored checks and stale checks and that kind of stuff. So yeah, should we call this the end of a chapter? Am I not sharing my screen? Oh my god, I asked you guys at the start if how my screen was and stuff, and nobody answered. This is why I don't like it when nobody answers. Like, can you guys please speak or answer or be alive? Thank you. Can you see it now? Well, anyways, I was discussing this part, and we finished it. Now, for the bank reconciliation, how to prepare it and stuff, I don't really feel like using the textbook to explain it. So I'm gonna instead use some topical questions. I need some water. Okay, anyways, we're doing bank reconciliation. Okay, let's do this one, I guess. Summer 25, paper 22, summer 15, sorry. 0452, summer 15, paper 22, question paper. Let's get this. This is question number one. Question number two, sorry. Okay, here we have it. All right. Two reasons why a trader should reconcile the cash flow with the bank balance. Sure, sure, sure. You can just, do this as theory. All right. David Jones balanced his cash book and wrote down a debit balance of 114 on 1st of February. So this is a positive balance in the cash book. The bank statement showed a credit balance of 154, which is also a positive balance for us. This is the comparison of the bank statement and the cash book. Items appearing only in the cash book and only in the bank statement. For things that only appeared in the bank statement, we have to add them to our cash book. So let's do that. This is our cash book. G, exactly. All right, sorry for that. Let's continue. So we start with a debit balance of 114 on 1 February. So we just start this, and then bank charges appeared only in the cash book, only in the bank statement. We know that cash book is, debit positive since it's an asset. When the bank balance or cash balance increases, you debit the cash book. In this case, it's pretty much only the bank account because we are dealing with the bank statement and stuff. And this part is what reduces the balance, the bank balance. So let's just do bank charges here, 62, and check received from a credit customer got dishonored. Normally, if you receive a check, you would put it on the debit side, but since this is dishonored, you're going to put it on the credit side. Insurance paid, 40, interest on deposit uh, paid directly into the bank, so you're receiving money. And the total of the debit side of the cash book had been overcast. So to fix that error, you credit the cash book by $100. Now you calculate the updated balance of the cash book, and let's see what we get. 114 plus 130 minus 62 minus 143 minus 40 minus 100. So we get a credit balance of 100. Sorry, it's going to be on this side, 101, and that means that we have a negative bank balance of 101. Any questions so far? Okay. Now that we have our updated cash book balance, we're gonna make the bank reconciliation statement. So let's kind of just remove this part, clean this place. And this is our updated cash book balance, 101. All right. Now for preparing the bank reconciliation statement, these are the things that appear only in the cash book, so we have to put them in the bank statement, okay? Cash sales paid into the bank on 28 January, check paid to M Sharp or credit supplier. Okay. Anyways, cash sales paid into the bank. So how would you record this in the cash book? Would you debit this to the cash book or would you credit this to the cash book? Can anybody answer? If not, then just let me know. Like, how do you record this? No, this is cash from sales paid into the bank. So you make sales, you earn cash, okay? And then you take that cash and put it into the bank account. So your bank balance increases, right? You debit your bank account by what? By 235. And then you credit what? You credit cash because like it's a contra entry, but we don't care about what we credit since like we're only talking about the bank account, right? Anyway, so the bank account gets debited with this entry, which means that the bank statement should get credited, but it did not get credited. What does this tell us based on our textbook? 1 second, let me just open it. I think I can. How can I open it? Like this, right? There we go. So we discussed over here. What have we discussed? I'll just go there. All right. So it is debited to our cash book, but it is not credited to our bank statement. Okay. So this is what we're talking about. Uncredited deposits. They are not credited to the bank statement, but they are debited to our cash book. Okay. So what do we do in this case? It's debited to the cash book, meaning our cash book balance is more than the bank statement balance, right? And when we are preparing a bank reconciliation statement, our goal is to make the cash book balance equal to the bank statement balance. All right, so we start with the updated cash book balance, which we found was 101, credit 101. So let's just put it in brackets. It was a credit balance, it was a negative balance. All right. Anyways, 1 second. Okay, now we have our updated cash book balance. The next thing we'll do is we'll adjust for this. Our cash book is more by $235. We have to make it equal to our bank statement. Okay, so cash book is plus x is equals to bank statement, right? We want to make it equal to the bank statement. How will we do it? If we just subtract the value from the cash book, it's going to make it equal to the bank statement, right? So if we subtract uncredited deposits, 235, it's now closer to the bank statement. Does anybody understand the logic that I'm trying to explain? Okay, anyways, then we pay a check, and this is not recorded in the bank statement. When we pay a check, we credit our cash book, okay? We credit our bank account by 490, okay? And in this case, this was not recorded in the bank statement. And the bank statement is the opposite. If we credit it, then it should be in the debited to the bank statement. But it was not debited to the bank statement, which means that this is an unpresented check. It's not debited to the bank statement. This means that your cash book balance is lower because you have credited your cash book, and then you have not adjusted your bank statement accordingly. So if you add value to your cash book balance, if you add 490 over here, so you do unpresented, add unpresented checks, and then you do 490, that is going to give you something equal to your bank statement balance, or it should. If it doesn't, then our answer is wrong. Let's check if it is wrong or if it's right. Minus 235 plus 490, and we get 154, which is equal to the bank statement balance. All right. It says that a credit balance, which means a positive balance, and we have a positive amount over here. So yep, this means that we have a credit balance of 154, which confirms that our answer is correct. Over here in the updated cash book, we got a balance CD on the balance BD on the credit side, 101. And for the bank reconciliation statement, I've just done it here. And yep, I hope you guys understand the question and the concept of how we calculate it. Is it clear? In case you still want more questions or more explanation and stuff, by the way, even when there's an overdraft, it's the same thing. It's the same. It's literally the same. Okay. If you don't understand this even now, and maybe you want more explanation and stuff, then just go to the accounting chat and then go to the pins and then go to the videos over here, the list playlist, open it, and then just go to the speedrun part, and this has just open it in the browser, and you can go somewhere around 1 hour 20 minutes or something, exactly right here.
Exactly. Okay, let's move on.
And this is just a speedrun of 1 year ago, okay, 10 months ago. We did for the May June session, and we're doing it again for the May
Trust
June
me.
session. I'm just checking if this is bank reconciliation. I did a pretty deep explanation here, but it's not loading. But yep, we can just see the timestamps. We cannot. Well, anyways, you guys can check it out yourself. It's there.
Receiving this money. That's why I
Oh
have to
dear,
reduce it
I
and
should
have it
continue my
included on
niche.
the credit side of the trade receivable account. Now, what is the detail I have to write over here? It's gonna
Let's
be bad debts
push
because
it
this
out.
debt, this trade.
There we go. Okay, then now we should move on to the next chapter. This chapter is errors, and again for this chapter as well, there's not really anything that you have to know like that, but we're just gonna do this part. Okay, anyways. So you know how we have a few books of prime entry, right? We have the sales journal, purchase journal, sales return journal, purchase return journal, and we have our general journal. Is that all? Uh, I'm missing something. Sales returns, purchase returns, and then general journal. Okay, all right. The journal or the general journal is a book of prime entry, and then every transaction is recorded in a book of prime entry before we enter them in the ledger, right? We all know this. So we have our business documents, and then we record stuff in the ledger, the books, in the journal, the books of prime entry, and then we put them in the ledger, and then we make the final accounts from there, the financial statements from them. Okay. Now, if something is not entered in one of the books of prime entry, which is the cash book or the journals, the sales journal, purchase journal, sales return journal, purchase return journal, if it's not entered in those, then it has to be entered in the general journal. Okay. So a journal entry, we already know the format, what to debit, what to credit, a narrative. Usually the exam doesn't really ask them, but you need to know how to make them. It's just a comment of whatever is happening um, in the entry, like what the purpose of the entry is, and of course the date. Okay. The narrative is a brief explanation of what's being recorded and why the entry is being made. You need to, write it so that you can remember why you have making this entry and that kind of stuff. Okay, because sometimes it's not something normal. Like if I tell you debit bank credit motor vehicle, then you can tell that fine. It's you're buying a motor vehicle. It's simple to understand. But sometimes when you're correcting an error, it's not easy to understand because the entries are not something that happens normally. So it won't make sense. So you need to give a narrative to explain your purpose of making that entry. Now we have in the general journal opening entries as well. When you open a new business, you have to record opening entries. We have not discussed so far how to record opening entries, but we will in this chapter. And it's kind of important. They ask questions about it, usually like 4 marks or 5 marks. And then if you buy and sell non-current assets, the disposal account and all of that stuff comes in the general journal first, and then it goes to the ledgers. And then all your year-end transfers, the journal entries are made in the general journal, and then collection of errors as well, because that's not something you put in cash book or any purchase journal or sales journal, right? So all of these things go for the general journal because they're not related to your day-to-day activities and stuff. You get what I mean? Okay, so opening journal entries is, of course, when the business opens, when you start the business or when you first start keeping accounting records. It lists the assets owned, it lists the liabilities, and then it shows the capital as the balancing figure. Basically, the accounting equation. Okay, the opening entries is the accounting equation. Second, all right. This is an example. You have to take all of your assets, list them in one place on the debit side, of course, and then take all of your liabilities. And then a bank overdraft, negative bank balance is also a liability because you have to pay it back. And then the remaining balance, the balancing figure is your capital. The difference between the assets and the liabilities, of course, like we can get that from the accounting equation as well. Okay. And normally for journal entries, it's usual. It's like standard to show the debit entry first, and then show the credit entry, and then you have to indent the credit entry to kind of let people know that it's a little different from the debit entry. That's why you'll see that even when correcting errors and stuff, maybe your teacher or someone, they're gonna write like debit XXX, and then they're gonna write credit a bit far away. You see, it's not right under debit, okay? Because that's just the format. That's just it looks cooler that way. You get what I mean? All right. And capital is difference between assets and liabilities. We know that. Okay, then this is after you make the journal entry in the general journal, you put everything into their ledgers. As you can see, premises is being debited, so we debit premises. Fixtures is being credited, so we credit fixtures. So you're just posting it into the ledger, nothing really special, nothing so difficult. Okay, and you have cash on the debit side and you have bank overdraft. So in the cash book, you're putting both cash on the debit side and the bank overdraft. You see, there's nothing really difficult about it. But just know that when you're making opening entries, you have to take all the assets, take all the liabilities, and then get the capital. Okay. And then purchase and sale of non-current assets. This is, the when we learned depreciation, we learned all the entries. So over here, you make the journal entries, and then over there, like in the depreciation chapter and stuff, when we make the T accounts, I was explaining you guys, right? Debit this, credit this. So those journal entries are what we put them here. Okay. Let's look at an example. When you first purchase fixtures, you debit fixtures account and then you credit whoever you purchase from. In this case, we purchased from office supplies. Seems like company because S is capital. I don't know, maybe because it's not your office supplies. It's not that asset. It's just from it's mentioned in the question, right? On credit from office supplies. Okay. And then when you're selling a motor vehicle, you debit disposal account, you credit motor vehicles account because it's reducing the value of the motor vehicle. So this is just journal entries. We have done these concepts before. When you debit your income statement because it's an expense, you credit disposal of motor vehicle because that's the cause of the loss. Okay. So yeah, everything we record is in the journals. The purpose of this is just to tell you that, connecting it with other chapters and telling you that this is useful. Okay. Then you have non-regular transactions, something like something that cannot be recorded in any other book of prime entry, like your sales journals or cash books. which are basically irregular transactions. They don't happen on a day-to-day basis, such as transfers to the income statement and that kind of stuff. And there's nothing really crazy about it. It's just the same thing. Okay, like we've all done this. And then you just post it to the ledgers once you have done the journal part. And then this is just a bunch of journal entries. And then this is just a bunch of ledgers from those bunch of journal entries. But like you guys already know journal entries, I'm assuming, because we have been doing them from the start. Okay. So journal entries is basically what to debit and what to credit, and then a small narrative next to it. So like we can tell that over here, income statement and purchases is the transfer of purchases for the year to the income statement. Purchases is being credited because the total of the purchase itself is debit positive, and then when you want to transfer the total, you credit purchase account. And income statement is being debited because purchases reduces profit. So like we know this stuff. So yeah, making journal entries is pretty simple. Now this is the main part of this chapter, correction of errors. In chapter 3, we discussed the errors which are not shown by our trial balance. These are the errors which we have to correct. Okay. And if we find them, we have to correct them, of course. And they'll be corrected by a journal entry. That's why they were introducing us to journal entries so that we can correct errors. These are a bunch of errors, and then these are a bunch of corrections. And then there are some errors which affect the trial balance, and the totals of the trial balance will not balance. If the errors are not found directly, like of course it's sometimes not easy to find the errors. They won't just spawn. So you have to wait and think and find them. But before, like while you're finding them, you have to create this temporary account called the suspense account. You just put the remaining balance in here, and then you make your trial balance. Okay. So for example, if my debit side in the trial balance is 400 and my credit side is 1000, then I'll just put a suspense account over here for 600 just to make it balanced for now. Okay, just like to kind of let myself know that there's a $600 error, but the trial balance is balanced and stuff. Okay, and you're gonna have the suspense account till all the errors are discovered. If there is a balance remaining on the suspense account, like if the suspense account does not become zero, that means all errors are not discovered. Okay, ensures that all errors are found. As the errors are found, the appropriate entries are made in the ledger accounts, and you correct them through a journal entry. And if all the errors have been corrected, the suspense account will close. Its value will become zero. If it doesn't, then there's still an error. Okay, a balance remaining on the suspense account indicates that still some errors are in the accounting records. And then this is just some more error examples with the suspense account. And then this is something important, effect on the profit of each error and correcting the errors. We'll discuss this as well. And then effect on assets and liabilities of errors, making errors. Okay, that's it for this chapter. So let's do a question because that's the best way to understand this chapter since it's only double entry. To be honest, I think I will only do a short question because if you guys wanna, go for a more detailed explanation, then again, just go to this playlist. Oh my God. Anyways, just go to, I think I'll just uninstall this Loki. It's like it's not helping anymore. Second, the problem is that I have an honor tab and it's from China, so Google doesn't really work properly. So I can't really download YouTube. I have to use the website. Okay, this correction of errors. Here I have done a few past paper questions, and you know, thing is, yeah, the thing is that this chapter is only explained, like I can explain it better by doing questions because that's how you're gonna understand stuff. Okay, since it's too basic, correction of errors. Okay, I've done a bunch of questions over here. You guys can, watch it. But for now, for this sake of this session, I will also do a question or two. Let's find something here. Or do you guys have a question of your own? We can do both. If you guys have a question, we can do that. What do you guys say? All right. I don't think any of you are you guys alive? Guys, are you alive? I feel like five people just died on me. Oh my god, you guys are alive, surprise. Okay. I think one of you is alive, the rest were still passed out. It's kind of sad. I get a patient, nobody shortly. Okay. Well, it's kind of sad that they're offline and they're missing out on this. But well, anyways, they're probably not offline. I hope they're not. All right, then let's do this question. It's looks quite challenging, to be honest, but it's all right. It's easy. Let's just put this in here and let's finish this quickly. We are gonna do this in 15 minutes, hopefully. Let's see how long it actually takes us. 3, 6 minutes. Okay, this is the question. All right, Asya is a trader. She prepared her trial balance at 31st August. The credit side totaled 273 more than the debit side. So let's just say that the debit side is 100. Okay, so the credit side would be 373. All right, this means that we're gonna place the suspense account on the debit side or the credit side. Anybody, please answer. We want to make them to be equal. Yep, exactly. So we do 273 as suspense on the debit side. Okay, so when we're making our suspense account, we are gonna put a debit balance of 273. Okay, and we're gonna label it difference on trial balance. So we start with our suspense account. There we go. Let's just label this suspense account, and we start with difference on trial balance. By the way, in your exam, you have to write it completely difference on trial balance. And then we just do 273. This is the debit side, this is the credit side. All right, a credit purchase from Jacques had been entered twice in the purchases journal, which means that purchases are overstated by 112. So we have to understate purchases. Purchases normally have a debit balance. Okay, so to understate purchases, to reduce the value of purchases, we're going to credit the purchase account. Is that right? So if we just credit the purchase ledger, purchase account, this will be fine. So let's credit purchases by how much? 112. Now, what do we debit? There is nothing to debit, right? Since there is nothing to debit, but we need a debit entry, we will debit suspense by how much? 112. Okay. The wages account had been overcast by $300. Wages is an expense account. Expense accounts have a debit balance. If it's overcast, which means it's overstated, okay, by $300. If its value on the debit side is greater by $300, what do we do? If we credit it by $300, it's now equal. Is that right? So we credit wages by $300. Again, there is no debit entry. What do we debit? We can debit suspense. For how much? 300, of course. All right. Then we receive cash. Oh, by the way, I have to debit suspense over here. So we're gonna debit with purchases, 112. And then we're gonna debit for wages, 300. All right. Cash received from Savannah, a trade receivable, had only been entered in the cash book. Now, when we receive cash from someone, what do? We debit cash because we are receiving cash, and then we credit the customer's account, right? Credit Savannah. But in this case, we did not credit Savannah. Okay, we had debited cash. So now we credit Savannah to fix the error. And then since there is nothing to debit, we're going to debit suspense. This feels kind of weird, bro. Everything is being debited to the suspense account. Nothing is being credited. Feel like I might be making a mistake, but trust the process. Stylus acting weird. Oh my god. The total of the sales returns journal. This is a debit account, by the way. Sales returns is a debit account. For August was 198, had been credited to both sales returns account and purchase returns account. So it was credited to sales returns account. That is wrong. Okay. So first thing you do is you debit sales returns account to fix the error by you debit it by 198. Then you debit sales returns account again to actually record. Wait, sorry. Then you 1 second. Let me just I need some more space. Yes, I'll just zoom in. So the first thing you do is you debit your sales returns account by 198 to remove the effect of the crediting, so you credited it wrongly, right? And then you debit your purchase returns account because you credited that when there is absolutely no reason to. You credited it by 198, so you debit it by 198 to remove the error. Now you debit your sales returns account again because you have to actually record the sales returns. In the first time you debited it so that you remove the effect of the error, the credited effect. So it was credited. So first you debit it to remove the error, then you debit it again, and yeah, that fixes the error. Okay, but as you can see, we have no credit entry. So what do we credit? Well, we're gonna credit suspense. So let's calculate this. 198 plus 198 plus 198. Boom, credit. It's just indented a bit for the formatting. Suspense by 594. Okay, and over here you're gonna write sales returns is gonna be 396. Then you're gonna write purchase returns as 198, and the total of this will be 594. But we don't need to mention that right now because we're not completed yet, right? A payment to Sophie of 93 had been recorded as 39 in Sophie's account. When we make a payment to a supplier, what do? We debit supplier account, so we debit Sophie, and we credit cash or card, right? Okay, so cash or bank. Anyways, so instead of debiting Sophie by 93, we debited Sophie by 39. So let's see how big the difference is, right? 93 minus 39. So we basically understated Sophie's account by $54. We have to pay or record that we have paid more. We have to debit Sophie's account by $54 more. So let's do that. We debit Sophie by $54 and then we credit what? Since there is nothing to credit because cash was recorded properly, they did not mention that cash or bank was recorded wrong. So we credit suspense in here because we need to balance the entry, right? And then on the credit side of a suspense, we'll write Sophie, and the value will be $54. Now we check if our suspense account is balanced, which it surely is supposed to be. If it is not, then there is still an error, which the question did not tell us about. 112 plus 300 plus 75, 760 on the debit side, 396 plus 198. Nice. Okay, anyways, 396 plus 198 plus 54, and this is giving us 648. And if we just do 760 minus 648, this is giving us 112. Hmm, did I make a mistake somewhere? I wonder if I made a mistake somewhere. It's giving 112 balance CD. I think I'll check the mark scheme because I'm pretty confident, but 112 is quite a you know perfect number, so it's making me feel I don't know, what do we call it. Well, anyways, mark scheme 23, let's have a look. I'm still quite confident, to be honest, but let's see what the problem is. We have our errors and then we have suspense account as well, right? Okay, perfect. So this is question number 4. Let's do split screen, and there we have it. So the first one, let's kind of change the color to check. Wait, what? Oh, okay, wow. This is genius. I couldn't spot that. Anyways, had been entered twice in the purchase journal. All right, let's just check the others first. So that everything else is correct. Suspense and wage is fine. Suspense and Savannah fine. Sales return is 396. Fine. Purchase fine. 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 Okay. So yep, this is quite a crazy error of nice from my side, and I'm sorry for it. Let's just do this part again. 1 second, let me just clean this up. All right, there we go. It's gonna look better. All right. So the first question, a credit purchase, 112. 1 second. Any questions? Nothing. Okay. A credit purchase 112 from Jacques had Jax, whatever, had been entered twice in the purchases journal. You know what we how we record things in the purchases journal, right? So we basically have this journal over here, and then we have the names of our suppliers. In this case, we're gonna have Jack, okay, and we wrote 112 here, and then 112 again for the same person, meaning that in this dude's G account, in this person's, in the purchase ledger in his own account, we have purchases twice, which is going to come over here and over here. So we have to fix this error, and also in the purchases account, which is in the nominal ledger, by the way, is going to be Jack's twice, right? So his name is going to be there twice. So we have to fix this error as well, because if it's uh if it's in the book of prime entry, then the error follows everywhere on the double entry. Okay, so this is the first entry and this is the second entry. The error goes on both sides, and we have to correct both sides. So there was no suspense involved. I thought that there was, so that's a mistake from my fault, because probably a skill issue. Anyway, so you have to fix this error that Jack's account is being more on the credit side. So you debit Jack to kind of remove this error, and then you credit purchases to kind of remove this overstatement, right? And then both will be by 112, and that's gonna remove this part, which is gonna give us a perfectly balanced suspense account. So while doing this, I lost 1 mark, but we gained the rest, 15 out of 16. Okay, now for something. All right, anyways. Now for something interesting, I guess this is kind of difficult, but it's covering everything the textbook has. We are also covering the effect on profit from errors, which is a really good topic. A credit purchases from Jack's had been debited twice to the purchases account. The effect of each error, okay, not the effect of correcting the error, the effect of the error itself. So over here, purchases are being debited twice. Your purchases are being overstated. If purchases are overstated, your cost of goods sold will be overstated as well. Everybody agrees. And then if cost of goods sold are overstated, then your gross profit will surely be understated, which will lead to your profit for the year also being understated. Okay. The wages had been overstated by 300. Your expense being overstated, of course, it affects your profit for the year, and it does not really affect your no effect on gross profit. It does not affect your gross profit. It affects your profit for the year. Okay, so like there's literally no effect. But anyways, so yeah, it's gonna decrease your gross profit for the year, because it's overstating the expense. So if your expenses are more, your profit will be less. And then for the gross profit, it won't affect the gross profit because expenses are after the gross profit. Okay, gross profit is only affected by sales and cost of sales. All right, so no effect on gross profit. And then cash received from Savannah, a trade receivable, had only been entered in the cash book. This does not affect anything, because when we make sales, when we made the sales, when we made the credit sales, that's when profit was affected. Okay, this over here only affects the trade receivables, which is not related to the profit. It's related to the assets. It's related to the statement of financial position, not the income statement. Okay. And then the total of sales returns journal had been credited to the both the sales returns account and the purchase returns account. This is probably the most technical one over here. So your sales returns journal had been credited to sales returns account. What is the effect of this part? Let's just break it down. 1 second. There we go. Okay. Sales returns is normally supposed to be debited. All right. You forgot to debit it, which means and you credit it, which means that you understated your sales returns. Okay. And that means you basically increased your total sales. You had sales returns, customers returned goods to you, but you did not record that. You credited that, so you overstated your sales by two times because like one time for not debiting it and then the other time for crediting it. So what was the total amount again? 198 plus 198, 396. You overstate your sales by 396. And then the effect of the purchase returns account being credited, which means that you're basically recording purchase returns. That reduces your cost of goods sold, by the way. If you have purchases, it's going to increase your cost of sales. If you have purchase returns, it's going to decrease your cost of sales. Okay. So you're decreasing your cost of sales, which will lead to an increased gross profit. So you're overstating your gross profit by 198 due to the purchase returns. So both of these, you're increasing your profit by a lot. If your gross profit increases, your profit for there will automatically follow. So let's just put it here and put it here. A payment to Sophie had been recorded as 39. Again, this is something to do with the assets, not the profit, because the profit will be affected when we purchase the goods on credit. Okay, so again, no effect. Now let's look at the mark scheme right here. So we have, one second, let me just change the color. All right, we have under profit for the year under. Wait a second. Oh yeah, this is given to us by the question. Then for the second one, we have only profit for the year understated. There is nothing on gross profit, no effect. Then we have no effect because this is related to assets. Then both of these are overstated, and the last one also no effect because it's related to assets. Okay. I hope that this chapter is clear. Let's just quickly look at the textbook to make sure that we've covered everything. So we covered this part ourselves. And then for correction of errors, we corrected a bunch of errors. We know errors which affect the trial balance. That's why the suspense account was created. We closed the suspense account once we created it. We corrected all errors. We understood the effect on the profit of correcting errors and the effect on the profit of having errors themselves. And we also talked about the effect on the financial position, statement of financial position, that some errors affect the assets and they don't affect the profit. Some errors affect the profit and they don't affect the assets. And yep, for more, for more questions, no worries, man. For more questions on this chapter, like if you want to see solve more questions, then just watch that video I told you guys about. Now let's move on to the next chapter, which is quite simple. We can finish this in like 5 minutes, maybe. Actually, yeah, let's challenge to finish this in 5 minutes. So control accounts, also known as total accounts, total trade receivables and trade payables for sure directly. If a trial balance, fine. Okay, so the control account is for a sales ledger. It's gonna have a summary of the sales ledger and it's gonna have a summary of the purchase ledger. All right. Sales ledger is the accounts of trade receivables. Purchase ledger is the account of trade payables. So control account is basically summary of trade receivables and summary of trade payables. Okay. And when you make a control account, they act as a check or they verify the individual accounts within the purchase ledger and the sales ledger. But again, these accounts can only check the arithmetical accuracy. If you have any error such as commission or error of omission or error of commission, it won't really be revealed by the control account. But still, it's kind of useful. So there are a few advantages: assist in locating errors. They are proof of arithmetical accuracy, and then you can easily find the total trade receivables and total trade payables. For your financial statement of financial position and for calculating bad debts and all of that stuff. And then draft financial statements can be prepared quickly because of the balances provided by the control accounts. Like, yeah, you can prepare financial statements quickly, pretty much the same as point number 3, but draft financial statements, not fully financial statements. Okay. They help reduce frauds because the control accounts are prepared by someone who did not make the ledgers. So control account is made by someone from outside and it's made from the books of prime entry. It's not made from the ledgers. So that's why it kind of if the people who were in your accounting, I don't know, accounting department, if they were all planning a fraud and they were, bullying you with your credit, what's your credit customers and stuff, and they were stealing money, then control accounts will probably help find that, because the person making the control accounts is not going to be involved with your accounting department, okay? And they're also not going to make the control accounts from the ledgers, they're going to make it from the books of crime entry. And you also have a summary of the transactions relating to the trade receivables and trade payables. Like you're going to have all the amount you receive from your customers and all the sales you made to credit customers and all the bad debts you have from credit customers and that kind of stuff. Okay. So it's good. All right. And we know that sales ledger control account is basically trade receivables account, as we just discussed this. And we know that trade receivables is an asset. And we also have learned that assets have debit positive balances, meaning anything that increases the asset will come on the debit side. Anything that decreases the asset will come on the credit side. So anything in this case that increases trade receivables, which is if you sell goods on credit, it's going to increase trade receivables. If somebody has a dishonored check, they owe you money again, like somebody pays you, he doesn't owe you money anymore, right? The amount he owes you reduces. But if his check bounces, if it dishonors, then he owes you money again. So that's why it's increasing the trade receivables. So it comes on the debit side. And then if there's any refunds, so like you somebody pays you and then like asks for a refund of money or something, or like the bank itself refunds or whatever. Right? Sorry. Uh, yeah. Yeah, I think so. All right. Anyways, and then interest charged. This is not an expense interest charge. This is when you charge your customers interest because they're paying late. Okay, so of course they have to pay you more, and that's why it increases the trade receivables. You're gonna earn more from them. They owe you more. Okay, and then over here, sales returns. It reduces the amount the customers owe you because, like, if I bought goods from you of $1 million and then hmm, if I bought if I bought goods from you for $1 million and then I like returned 500,000 of them, so I have to pay you only 500,000. Now I don't have to pay you a million again. So it reduces the amount I owe you, right? Same for cash. If I pay you money, or if I pay you with bank, or if you give me a discount, or if I don't pay at all, if I run away with the money, I don't owe you money anymore. So boom, that's gonna be it's gonna reduce your trade receivables. Okay. And then this is where you get your source of information. Sales related you get from sales journal. Anything related to money you get from cash book. And then anything related to non-regular activities, which is irrecoverable debts and interest charged on overdue accounts, because that's not something you do every time, you get them from the general journal. Purchase journal is really similar to the purchase ledger control account, is really similar to that, except that this is for trade payables. So it's a liability, and liabilities are credit positive, which means that every time the trade payables increase, you're going to credit the trade payables account. When you buy goods, the amount you owe the suppliers increases, or when the suppliers charge you interest, the amount you owe them increases, or when you like when you ask for a refund and then they give you money back, the amount you owe them increases. Purchase returns, the amount you owe them decreases. You pay them, the amount you owe them decreases. You receive discounts from them, the amount you owe them decreases. Okay. And then again, purchase related things from the purchase journal. Anything related to receipts and payments is from the cash book. And then interest charged, if you receive interest, that's going to be from the general journal because it's something, random. And then sometimes you're going to have balances on the debit side and the credit side of a control account. The main balance would be the one, you know, uh, that's like on the plus side. Because like if it's a sales ledger control account, the main balance would be on the debit side because it's an asset, it's debit positive. And then the balance on the credit side is a liability. It represents what you owe customers. Okay. So like it tells that you have to pay customers this much. But what do you mean you have to pay customers? Well, there are scenarios where, maybe the customer paid extra money, so now you owe him money. Or maybe the customer returned goods after paying the money. So like he pays you money, $200. Now you have his money, and then he returns goods worth $200 as well. So now you have the goods and you have the money. So you have to give him his money back, right? So that's you owe him money. That's why. That's why it's going to be shown as a credit balance, because like it becomes a liability, right? The customer pays in advance for the goods. So in that case, also you have the money and you have the goods. So you have to give the goods to the customer. That's why it's a liability. It's right after this chapter, by the way. So like in 3 minutes, I suppose. Okay, and then cash discount not being deducted before payment was made. Maybe the customer deserves a cash discount, but you did not deduct it. Okay, like you just didn't do it by mistake or whatever. So in that case, also you owe them the money of the cash discount. Okay. So yeah, the same concept applies for the suppliers for the purchase ledger control account, except that it's just like about suppliers and stuff and not customers in this case. And then you have contra entries. but the concept stays the same. You just debit whatever increases trade receivables and you credit whatever increases trade payables. So as long as you remember that and understand that, everything in control accounts is simple. Most people say it's format based, but I don't really agree. Like, sure, it is format based. Memorize the format and you're good, but you're gonna have to memorize the format instead of memorizing the entire format. Just understand it. It's really simple. Well, we are starting chapter 17, sorry. But before we start, we're gonna take a 5 minutes break because I have to drink water and I have to eat a croissant. Okay, let's continue. So incomplete records, somebody asked to ping, right? Who is it? Ping me when you start incomplete records. Where is it? Okay, ZSE, are you there? Are you there? Are you there? Not there. Yes, you're there. Okay, that's good. Okay, perfect. All right, then let's begin. So incomplete records. This chapter is pretty nice. It's okay. It's meh, but it's simple. The only problem, or like you could say, the only technical thing is usually this part right here. Okay, and this is theory. You guys can literally do it yourself. This is very easy. It's just the statement of financial position. This is also super easy. It's literally just the capital account, and this is also super easy. It's just the control accounts and then just some reverse engineering and algebra. And then this is also very easy. It's just a normal income statement and statement of financial position. And then this is also normal as your previous adjustments to statement of financial position, which we did in chapter 11. Okay. So in short, the main point or the main different thing in this chapter is markup and margin to calculate missing figures. And even in there, the main part is to convert between markup and margin. Okay. That's where people struggle and become clueless. All right, but we're gonna go through everything, so let's get right into it. So some businesses, usually small businesses, don't maintain a full set of accounting records because they can't really bother or they don't really have an accounting department or something as big, right? You don't really need it. Like if you're running a small supermarket, you don't really care about every single dollar you spend and that kind of stuff. So you just have some daily cash book and stuff maybe, but you don't care about all those ratios and every single thing, right? That's for big companies. Okay, so a trial balance cannot really be drawn up and the financial statements cannot really be prepared because you need some assets and liabilities and your profits and income or what inventories and that kind of stuff, right? You can't prepare these without that information. So you need a bunch of information so that a full set of financial statements can be prepared. All right. Anyways, now these are the advantages of preparing of like having double entry records. First of all, of course, the full details of every single thing will be there, which means that your assets, liabilities, revenues, expenses, everything is going to be there. It's good to have details, of course, which may mean that you can easily prepare financial statements. And then if you have like if you have good details and accurate details, then your profit will be more accurate. But if you're just guessing and stuff, then your profit is going to be, of course, inaccurate, right? So that's that. And then if you have accurate profit, you can have better decision making. And then in all of these, like you guys can read this, there's nothing really special about it. And then you can even memorize them because like it's just theory. Doesn't really, it's like the same for every question. But then for questions, for actual questions, you need to understand the question. You need to understand the topic because every question is different, right? Well, anyways, just give me a second. Okay. So let's move on to the next part, statement of affairs. This is, as I mentioned before, basically your statement of financial position. We have in the statement of financial position, we have our assets, liabilities, and capital, right? So here you have the same thing. Summary of the financial position. It is prepared instead of a statement of financial position, and it is prepared when double entry records have not been written. Okay. Oh my God, it's too dark there. Is you guys are hearing a bunch of background noise, right? Well, I guess somebody's already answering. Voice and go. Okay, well, anyways. So yeah, you can see over here that you basically have to, or the assets and liabilities, which is exactly similar, like pretty much very similar to the statement of financial position, except that you can't really call it a statement of financial position because that's prepared when you have double entry records, like full detailed double entry records. Okay. So yeah, you have a list of assets and liabilities without the use of double entry records. That is the statement of affairs. Oops. Okay, let's kind of turn that off. Okay, anyways. Yeah, that is the state of affairs. And then if you have these assets, liabilities, and capital, and you have no other information, then you can get the profit because, of course, you need to know your profit, right? You can get the profit by checking the change in the capital. Okay, capital increases when a profit is made and decreases when a loss is made, and we know that, right? So, in just to calculate your closing capital, I want you guys to understand this formula. Closing capital, bro. Okay. Closing capital is going to be your opening capital plus anything that increases capital. What increases capital? Profit increases capital and additional capital increases capital, right? So closing capital is going to be your opening capital plus profit plus additional capital minus anything that decreases capital, which is drawings. Drawings decreases capital, okay? And losses also decrease capital, of course. So opening inventory plus profit plus accumulated plus additional capital minus drawings minus any losses, and that's gonna give you your closing capital. Okay, and then to find the profit, you can just kind of do some algebra, make profit the subject, and you're gonna come up with this formula. Capital introduced is the same as additional capital. And yep, and then you can also make a capital account because, like, that of course looks better and you're less likely to make a mistake. And I would kind of recommend you guys to make an T account when it's possible. You don't have to make a perfectly looking, beautiful T account. You just have to make it enough for you to understand and so that you don't make a mistake, okay? All right. This is an example of the statement of affairs. As you can see, they just have a bunch of assets and then some liabilities. And as you can see over here, they just put the assets, just put the liabilities, and capital is the balancing figure. This is at the opening date. This is wrong. It's not 31st May. This is 1st May. This is the opening statement of affairs. The closing statement of affairs will have calculation for the closing capital. So it's gonna have all these adjustments as well for depreciation and other things. So you have again the same thing, your assets, you have your capital as a balancing figure, and you have your liabilities. And then you calculate your profit by doing closing capital. You just make the capital account format. You just have your opening capital here, you have your closing capital here given by the question, you have your drawings given by the question, and you have your additional capital, and you have your profit. So you can find where is it? Sorry, the profit is the balancing figure. One second, this purchases is probably goods drawings, right? Let me just check. Yep, 3,000. Okay, so this is to record the goods drawings. This is reducing capital as well, and then the cash drawings is also reducing capital. And the balance CD is the closing capital, which we calculated in the statement of affairs. Opening balance is the balance CD is the opening capital, which we calculated in the opening statement of affairs. And then equipment is the additional capital, and then profit is our balancing figure, which we got when we checked the difference between these two. Okay, if it was a debit balance, then it would be a loss. All right, that's that. Now moving on to find the opening capital, we make a statement of affairs opening, and to find the revenue for the year, to find the sales, we make a control account, and then by the way, the control account will only tell you the credit sales. Okay, so then you have to add the cash sales, which is going to be given to you by the question, and then for the purchases, you also make a control account, but again, this will only tell you the. One second. Oh no, just give me a bit. Control accounts we use trade receivable stuff since we want to find sales. Sales ledger control account and control account, I mean the same thing. If you want to find sales, you find credit sales first and then you add cash sales, okay? But how will you find credit sales? You're gonna have to make a sales ledger control account to find credit sales. Then what about credit purchases? You're gonna have to make a purchase ledger control account to find credit purchases. And then you just add your cash purchases to that, and then it becomes purchases for the total purchases. And then for the closing bank balance, you just start with your bank balance, and then you make a normal cash flow. Okay, so yeah, you can see over here total trade payables account, and it has the same format as a purchase ledger control account, because we already discussed, right, that the purchase ledger control account is a trade payables account, and the sales ledger control account is a trade receivables account. Okay, and then for the bank account, you just have your normal bank account. There's literally nothing difficult about this. Debit whenever the bank balance increases, credit whenever the bank balance decreases. Payments decrease the balance, receipts increase the balance. Opening balance is given to us. We find the closing balance ourselves as the balancing figure. Then when preparing the income statement, we take the sales we found from our control account. We take the cost of sales. We have the opening inventory given by the question, closing inventory given by the question, usually given by the question, by the way. And then we found purchases from the purchase ledger control account. Goods for own use, we are given this by the question, I suppose. Let me just check. Uh, second. Anyways, so yep, I don't see it, to be honest. Where is it? Drawings. There we go, 4,000 drawings for our own use. So that's why we have goods drawings in the income statement. And then we get to our cost of sales, we get to our gross profit, we subtract all our expenses, and depreciation, as you can see, is in the last because it's a non-monetary expense. What are you teaching right now? How long till the session ends? I'm on chapter 17. I have no idea when the session will end. And I'm 17. People not working. 17. No idea why it will end. Anyways, so let's get right into it really quickly. Okay, and then you get your profit for the year, and yeah, that's that. Then you make the statement of financial position, because like in this case we have enough information to make a statement of financial position, right? Because we have these four. If you have these four, you can make the statement of financial position, and then you have also given us other information. So yep, we start with our assets like normal, just a normal statement of financial position. For capital, we have opening balance plus profit plus drawings. We represent everything like normal, and then we also have our liabilities, and then they both should balance. Everything is normal. Everything is the same, to be honest. Nothing different. And again, just the control accounts again. And now we have a different concept finally. This is markup and margin, and then we have another concept, rate of inventory turnover. Let's quickly go over these. Markup is basically gross profit over cost of goods sold, okay? And margin is gross profit over sales. One second. All right, anyways, so gross profit over sales, this is margin, and the gross profit over cost of goods sold, this is markup. Now, this is basically what it does. If you have your gross profit, sorry, if you have your cost of goods sold and you want to know your gross profit, you can just do cost of goods sold into margin, and you're gonna get your gross profit, and vice versa. So that you can find values that you did not know using this information. Okay, and then the same is for markup. The same is for margin. You can find lost information. The thing is that the question doesn't come as easily. You have to usually convert from markup to margin, and let me just tell you how that happens. Basically, markup, as we talked, is gross profit over cost of goods sold. Now, this is just something I'll remind you guys of. Sales minus cost of goods sold is equals to gross profit. We all know this, we do this in the income statement, right? So we can rearrange the formula. Sales is equals to gross profit plus cost of goods sold. We can also rearrange it to make cost of goods sold the subject. So we can go like cost of goods sold is equals to sales minus gross profit, right? Okay. Anyways, now that we know this much, we can convert from markup to margin. Okay. What is markup? Markup is gross profit over sales, gross profit over cost of sales. And what is margin? Margin is gross profit over sales. So can you convert from cost of goods sold to sales if you have gross profit? You have cost of goods sold and you have gross profit. Can you make sales? Yes, you can. If you have cost of goods sold and you have gross profit. So if you have cost of goods sold and you have gross profit, you can find sales. How do you find it? You add cost of goods sold with gross profit. Okay, so we basically do gross profit over cost of goods sold plus gross profit, and then that's going to give us margin. Yes, it will. Okay, so let's take an example. Let's say my markup is 20%, okay? Or let's say 25%. Now, 25% in fractions is 1 by 4. Okay, so markup, we know that it is gross profit over cost of goods sold. 1 by 4 means that $1 gross profit, $4 cost of goods sold. Okay, now I want to convert this to margin. How do I do it? I do gross profit over cost of goods sold plus gross profit, right? Now, what exactly do I do? I'm going to do 1 by 4 plus 1. That's going to give me 1 by 5. 1 by 5 is my margin. What is 1 by 5? It's 20%. So when your markup is 25%, your margin will be 20%. Okay, that's how you convert from markup to margin. And then margin to markup, you're just gonna make sales minus gross profit. So you're just gonna do 1 by 5 is 20%. If this is my markup, I'm gonna simply do gross profit over sales minus gross profit. So it's gonna be like what's it? 1 by 5 minus 1. So 1 by 4, that's my markup. Okay, so it's quite a simple concept once you understand it. And then we have rate of inventory turnover. I'm gonna do a question. Okay, so inshallah we can check there. So rate of inventory turnover is basically the number of times a business completely replaces its inventory in a given period of time, usually like 1 year or 1 month or 1 week, depending on what you're checking it for, right? So let's just say I'm checking it for 1 year, and if I have a rate of inventory turnover of 5 times a year, then that would mean that every year I completely sell my inventory and then I buy new inventory 5 times. And that's a good thing. It means that I'm making fine sales. If I have a huge rate of inventory turnover, then it means that I'm selling a lot probably. Or maybe it just means that I have a very little inventory. Well, anyways, so yeah, this is how you calculate it. You do cost of goods sold or cost of sales over average inventory. Average inventory is basically opening inventory plus closing inventory divided by 2 because there's two of them. There's opening and there's closing. And yeah, using this, if they give you the number of times or the rate of your inventory turnover, then you can find your cost of goods sold or your average inventory, right? Which is a good thing. So if I tell you that average inventory is 8,000, and if I tell you that number of times it's 15, so you can do 8,000 times 15, and you can find cost of goods sold. Okay, so that's how they ask you to find lost information, and when they give you ratios and stuff. So that's the incomplete records part. So as I mentioned earlier, the hardest part is to do the markup margin part and the uh, what's it and the inventory turnover part, finding the hidden, finding the lost, or you know finding the values. Okay, then let's open a question. I think I have the topic is open here. All right, let's just um, right here. Let's do maybe this question 2019, summer 19, paper 21, 0452, summer 19, paper 21, question paper, and we're gonna go for question number three. And just a second. All right, anyways, let's continue. Let's open this question paper. Okay, let's go to question number 3. And let's quickly do this because I have to go for lunch with my family. Let's not leave, but like just eat lunch. All right, then. I want you guys to please focus because I won't really be repeating anything and I'll be doing this quickly. So if you have any questions, please stop me while I'm explaining and ask the question as soon as you have it. And do not hesitate, okay? We had started a business selling office machinery at the start of the year, did not maintain a full set of accounting records. Purchase and sales were made on credit terms, meaning there is no cash purchases or cash sales involved, which would mean that everything can be found through the control accounts, all purchases and all sales. Was able to give the following information. This is the opening capital. That's good information. These are the non-current assets. This is the credit sales we have. That's fine. We know credit sales. We have related to cash discount allowed. This is related to sales. So then I'll just write an S, and then I'll just write an S. And this is purchases. So I just write purchases, and again purchases, and this is for sales, and this is also for sales. And then this is for purchases, and this is for sales, and then this is for our cash book. Fine, we can do that later. So right now we're talking about purchases. Let's just make a quick T account. Let's just call it purchase ledger control account. We're going to start with amounts paid to credit suppliers. When we pay money to our credit suppliers, it reduces the amount we owe them. So this is going to come on the credit side. I'll write 14625. And then cash discount received. This will also come on the credit side, 375. And returns will also reduce the amount to 140. And amounts owed to credit suppliers. This is balance CD. The balance CD will come on the debit side. So this will come on the credit side, 1434. And am I muted? Fine. Guys, I'm not muted, right? Yeah, I can hear myself. It says exactly. Can you maybe rejoin? Can you guys tell her to rejoin? Okay, then let's quickly just 14625 plus 375 plus 2140 plus 1434. That's giving us 18574 purchases. Okay. Next thing we have to do is calculate the amount received from credit customers. So let's do that over here. This is relating to sales and credit sales increases our trade receivables. So we put that on the debit side, 21640. Then next we have discount allowed. It reduces the amount the customers owe us, so 338 on the credit side. Then we have returns, which also reduces the amount they owe us, 2042 on the credit side. And then we have bad debts, which also reduces the amount they owe us, so 380 on the credit side. Then this is the amount they owe us. It's balance CD, so it's also going to come on the credit side. The balance BD will come on the debit side. Now let's calculate the amount we paid our customers paid us. 21640 minus 338 minus 2042 minus 380 minus 1980, and that's giving us 16,900. So let's just write the answer over here. And then next up, we have to prepare the bank account, insert the missing figure, which represents the total expenses for the year. Let's prepare the bank account over here, or actually, let's just prepare it over here because I can't really bother scrolling down. So the first thing we had was the opening balance in the bank account, which is 65,000 by the capital. Then we purchased, oh my God, Oh, this is kind of weird. He literally invested 65,000 and then purchased assets for 64,000. That's kind of weird, bro. Okay, anyways. So yeah, we purchased assets for 64,000 since we have no other source and since all payments are made through the bank and all money received was banked, we bought these purchases from our bank account and then receiving a loan for 5,000. And then credit sales, all sales are, this is credit sales, we don't receive any money. Amounts paid, 14625 is going to reduce our bank balance. Cash discount received, we don't really receive any money. We don't really give any money or receive any money. So this has no effect on your bank. Returns to credit suppliers, again, this is credit suppliers and credit customers, doesn't really affect your cash or bank yet. Bad debts written off, you don't really receive or give any money for this. Amounts owed, you don't really give or receive any money for this. 5392, this is your closing balance. It's a positive balance. The balance BD would be on the debit side, which would mean that the balance CD is on the credit side. So to find the missing figure for expenses, which would also come on the credit side, by the way, we will just have to use it as a balancing figure. 65,000 plus 5,000. This is the debit side, minus 64,000, minus 14625, minus 5392, which is given to us by the question as the closing balance. Our expenses are 14017. Supposedly, this is hopefully this is correct. Let's write expenses 14017. What's wrong with the pen? Okay, and yes, the rest is theory. This unfortunately did not include markup and margin, which is kind of sad, but I have to go for lunch now, and then we'll continue after a short 20-minute break. Oh, no. But before I go, I would like to check my answer with the mark scheme. We were doing paper 21. Let's just type question 21. And let's see if our answers are correct. Let's split screen this. Chat. Okay. And we have question number 3A, credit purchases. What the heck? What's wrong with these values, bro? Well, anyways, balance BD is 1434. Oh no, I completely forgot to calculate the purchases. Um, do you guys remember what purchases we got? No way, bro. Come on. Uh, okay, let's just look at the working. We will understand. Discount received, returns, balance CD, purchases. Yeah, this is correct. This is what we did. Oh, thank you very much, man. All right, so our purchases was correct. And then for our sales, we calculation of amount received from credit customers 16,900. This is also correct. Our working was also correct. We did all of this. And then for the bank account, we got 5392. Fine. Our expenses were 2883. We made a mistake here. Non-current asset 64,000. Let's just change the color of the pen. 65,000. Oh, okay. Wow, surprisingly, I missed trade receivables. Oh, that's kind of stupid of me. Well, they asked us to calculate the amount received from customers during the year, 16,900. We received that money, so we have to record it over here. But I didn't really pay attention, and this is what you could call a silly mistake, but it was a valid mistake. They got me there. And after that, we have added non-current assets, trade payables, and balance CD, which we get 1 mark for. 1, 2, 3. So we lose 1 mark here. And we have our expenses. That was sad. All right, anyways. Yeah, because it did feel weird. How do I have $14,000 of expenses when you're like literally a new business? Anyways, so yep, that's this. That's it for this. And the theory part, I don't really like to do it because like anybody can do it, and then you can literally see from the mark scheme. but the mark scheme doesn't explain the technical stuff. All right, then see you guys in 20 minutes or so. Once I have lunch, and you guys should probably rest as well. And after we are back, we will do one more question. Let's just write it down here. Break 10 minutes. Chapter 17. Past paper question. After break, and the break starting at 2:36 to 2:56. All right, then see you guys in a bit. So, like, you want to do a past paper for this right now? Because we finished this chapter, we finished the chapter itself, and now we're gonna do a past paper question, I guess. Although, yeah, fine, I guess. Do you have any way of bringing the other people back? Maybe you call friends of yours or something, because it feels kind of bad to have only one person here. You know what I'm saying? Oh well, the break ended a while ago. These people aren't back yet. I wonder why. Okay, thank you very much. Alright then, since you said chapter 17 and since I also had planned for that, let's continue with the topic for chapter 17 in complete records. Let's look for some other question. Let's do this. March 21, paper 22. 0252, March 21, paper 22, question paper. Hello there, welcome back. Did you call the others as well? Because, like, I don't know, they're not joining. The break is long over, bro. It's been 3 minutes past. I came like 4 minutes before the break was over. But anyways, so question number 5 is incomplete records. There we go. And yep, this looks perfect. We have margin and stuff, inventory turnover and stuff. Income statement. Okay, that's good. Oh wow, a few people joined. That's good. I don't have accounting. I just came for the aura. Yes, it is tough. I get your point. You know, like it's good to. Accounting is nice though. It's pretty chill. Should we start or should we wait for something? There's only two people here, like two accounting students. Oh wow, investment banking. Top. Well, you can always take it. You know, again, it's not that difficult. It's very easy. Yeah, that's pretty cool. Okay, well, I guess we shouldn't wait for anybody else. We have this cool guy, and then we have the dot person. So I guess we will just start, and then anybody who misses it or comes late can check the recording. All right, then we have a question here for incomplete records. This is a past paper question from 2021, February, March, paper 22. Okay, the question starts with Media opened a shop. So this is the first year of the business, provided the following information. We have this information, 130 units at also, by the way, we value inventory at lower of cost and net realizable value. The cost is the purchase price plus any expenses like carriage and works. So the cost is $72 for this. $72 per units and then 130 units. So we have a 9360 closing inventory. And since it's the first year of the business, there is no opening inventory. All right, good luck, bro. And our gross margin is this much. plus that is zero. Okay, and the cost of Maria's inventory, we literally just unintentionally did that, but there we go, that's the answer. Has not kept a full set of accounting records, provided the following information: sales made on cash terms. The sales for the first year were okay, so the total sales. Wow, why did they give it like that? Anyways, so the first 2 months is 10,800 each month. So we just multiply this by 2 since it is 2 months, which gives us 21,600. Then we have 12,000 each month. We multiply that by 8 because 8 months, which gives us 96,000. And then we have last 2 months, 16,200 each. So we just multiply this by 2 months, which gives us 32,400. And now we can calculate our total revenue. We just add the previous sales, 96,000 and 21,600. This gives us 150,000 of revenue. During the year, purchased 10,400 units. Carriage was paid on these units. Each unit is $70 and carriage is $2. So each unit costs us $72. 72 times 100 and how much? 1,400. This is 108,000. $100,800 is the cost. Took goods from the business for the year ended. No record was kept of these drawings, so we will probably be asked to. Okay, wait, how are they expecting us to? Okay, well, all right, let's see what the question asks us. Okay, it's only the trading section, which means actual gross profit. So we're gonna start with sales, which we found 150,000. So let's just do revenue 150,000. And we should also write in the brackets how we got it. 216,000, 21,600 plus 96,000 plus 32,400. And yep, that's 150,000. Next thing we're gonna do is subtract cost of goods sold. Since it's the first year, there is no opening inventory. We calculated purchases to be $70 per unit plus $2 carriage inwards multiplied by 1,400 units, which gives us 100,800 is our, we are doing a past paper question, and we have just gone over the question. Now we are starting the income statement, the trading section. This is incomplete records, and we calculated the revenue and we calculated the purchases. We calculated the closing inventory as well. Minus 9360. We're going to subtract that here. Minus closing inventory is going to be 9360. Yep. 9360. And let's calculate that. 100,000 800 minus 9360, 91,440. Something feels wrong, to be honest. I feel like I'm missing something, like something important or something. Oh, yep. Okay. Can anybody tell me what am I missing? Look, we cannot say that this is the cost of goods sold. Okay. I just said that 91,440 is the cost of goods sold, right? Well, that's not true. How not? Because the question says that Maria took goods drawings from the business during the year ended 31st December 2020, but there was absolutely no record. So we cannot know the cost of goods sold using our normal method, right? Okay. Right. But we have some information. What do we have? Gross margin. What did we talk about margin? We said that margin is gross profit over sales over revenue. In our case, 150,000. And this is equal to 40%. So if we do 150,000 times 40%, we're going to get gross profit. Boom. 150,000 times 40%. So our gross profit is what? 60,000. So we're going to go like gross profit is, let's just put it here. 60,000. And then that would make our cost of goods sold how much? 150,000 minus 60,000, 90,000. Okay. And now we can kind of reverse engineer it something. So what we do is basically cost of goods sold is equals to opening inventory, but we don't have any. So purchases plus carriage inwards, which we have already calculated within the cost of purchases. Oh, I should show it separately, I guess, because carriage inwards is shown separately in the income statement as a different expense. So let's do 1,400 times 70 times 70 units. That gives us 98,000 purchases, like purchase price. So purchases 1,400 times 70 per unit, 98,000 plus carriage inwards. This is going to be, sorry, 1,400 units and $2 per unit. So that gives us what, 2,800. And then we subtract goods drawings, which we don't know what it is. And then we subtract closing inventory, which we calculated to be 9,360. And then we're going to get 90,000. All right. So we can kind of use algebra here. Cost of goods sold is purchases plus carriage inwards. Opening inventory plus purchases plus carriage inwards minus goods drawings minus closing inventory. And now we can just do, some maths here. We can do, we can first put values here. 90,000 is for cost of goods sold is equals to purchases is 98,000. Carriage inwards is 2,800 if I'm right, if I remember it right. Yep, okay. And then drawings we don't know. Minus drawings minus 9,360. Now we rearrange the formula to make drawings the subject. Drawings is equals to 98,000 plus 2,800 minus 9,360, and then we can bring this here as well. Should make it minus 90,000. So let's kind of try solving that. I wonder what answer we're gonna get. 98,000 plus 2,800. Am I even doing this right? 9,360 minus 90. Yep, okay, perfect. So we have 1,440 is our goods drawings. As you can see, very sneaky question. You really wouldn't have got it if you downloaded in this thing. To drawings of goods, and this is 1,440. And so we subtracted. This gets us our cost of goods sold. And yeah, that's our answer, 8 marks there. And then the rest is theory. And this is irrelevant to our current topic, but find discount received, cash discount, credit note, purchase returns, debit, no, a direct debit, cash flow, placing a check. Yeah, we still have a lot of chapters left, to be honest. We have chapter 18, 19, 20, 21, 22. I don't know if we will be able to do it today or something. But yeah, let's not give up. Because like I'm kind of explaining and doing past paper questions. I don't know why I'm doing it, but I think it's because it's probably cooler that way. Hopefully people understand better that way. Anyways, thank you though. But what's actually sad is the number of people attending, bro. Like, come on. Paper two, let's open marks came 22. Close this here. Like it makes me question why I'm even giving the sessions when there's this less people attending. And then it makes me feel like I shouldn't give the sessions because they're kind of useless. But then like if even one person tells me that it helps them, I'd probably feel better. And they're saying it's recorded. So like they're recording it, but then I'm also recording it. I don't know why I'm recording it to be honest, but I'm recording it. Might put it on my YouTube channel. Yeah, exactly. All right, well, so let's check question number 5. 9360 is correct. And then we have our total sales 150,000, and our purchase is 98,000. Our carriage inwards 2,800. Our goods drawings is 2 marks 1,440, and our closing inventory is 9360, and our cost of goods sold 90,000, and gross profit as well. Everything's perfect. Thanks, man. Like I'm really confident with my explanation and teaching. Like I know that I teach good because when I was being taught accounting, nothing made sense. Okay, so like I used to go home and then kind of just I don't I don't know, like I was bad at it. Okay, so I didn't really study and stuff. But then once my teacher failed me the subject, I kind of got mad about it, and then I started studying and stuff. And like when I really started studying and then doing past papers and stuff, I would question why things happen the way they do. And then if I asked the sir this question, I'd be like, "Why is this happening?" He'd just be like he wouldn't really answer properly. He kind of dodged the question, and he didn't like me, so he wouldn't answer either way. So I kind of just had to do too much to understand it on my own. And then once I understood stuff on my own, I was like, "This is way too easy." And then I was like, "Why do they teach it like that in schools?" And then I was like, "I'm gonna teach it the way it should be taught." Cool, right? Super cool. Anyways, so yep, that's it for this chapter. And now moving on to chapter 18, which is also very easy because like it's really similar to it's just a copy of the previous chapters. Okay. So we have this thing called income and expenditure account, which is basically income statement. Okay. And then we have receipts and payments account, which is basically cash book. Okay. And then we just have another income statement here. And this is the normal statement of financial position, normal adjustments. Accumulated fund is basically capital. You see, every single thing in this chapter is what we've already done. Okay. So yeah, this is about clubs and societies, which is non-trading organizations. Basically, they're organizations that do not buy or sell goods, or they don't have services or anything. Like they're not there for making a profit. Okay, they don't care about the profit. They're here for facilities or services for members, and they don't really aim for a profit. And then subscriptions is the amount the members of the organization pay just to make sure that the organization keeps running and that it doesn't have to stop. Okay, and the person who is appointed to act as a treasurer, basically the one taking care of the club or society. He takes care of the accounting and stuff, and responsible for collecting the money and all. So he makes a receipts and payments account, and sometimes a trading account section of an income statement. Sometimes an income and expenditure account and a statement of financial position. Like this is not a sometimes part. This is something they make always. And receipts and payments account is something that's new to us. It's basically a summary of the cash book, and it's prepared by a non-trading organization. Okay, so you can't call it a cash book because cash book relates to trading or service businesses. Okay, while this relates to non-profit organizations and that kind of stuff. Okay, so here, look at this. Boom, receipts and payments account. What is this? Receipts, debit side of the cash book, credit side of the cash book. Anything you receive comes under receipts. Anything you pay comes under payments. Is it difficult? Like, can anything be simpler than this? Anyways, moving on to the income statement of a club or society. So, they have how to look at errors when doing income statement during exams. What do you mean look at errors? Like errors in your own answer or like errors in the okay. Well, so if you have to make an income statement and also have to make a balance sheet, then your balance sheet will not balance if your income statement profit is wrong. Because to make the balance sheet, you need closing capital, and for closing capital, you need profit for the year. But if you don't have to make a balance sheet, then bro, just check the question you get. Uh, like make sure you have accounted for everything. And yeah, that's usually it. Okay, well, anyways, let's continue. No problem, bro. Got you, man. Okay, anyways. So we have like even though the main purpose of the club is not to earn a profit, they sometimes have a trading activity. Okay, so like a small shop or something. Like like I went to a gym once. Okay, uh, which okay, one sec. All right, anyways. So no problem. Anyway, so like I once went to a gym and then the gym is upstairs, but then downstairs is the counter and cashier and registration and stuff. Okay. So there is a restaurant of the gym where they sell healthy food, and then there's a small shop where they sell like a protein and creatine and that kind of stuff, right? Gym stuff. So these things are not the purpose of the gym, but they're there, to kind of uh, support or like to kind of be there for the members of the gym. Okay, and these things earn a profit. These guys, they earn a profit and they make their income statement. Okay, so maybe there's a cafe or a shop, or like in this case there's a small restaurant and there's a small shop for the gym stuff and all. So at the end of a financial year they make a normal statement, a trading section only, and they just show how much profit was earned. Okay, and it's completely the same thing because there's literally nothing different. Any expenses which is relating to the trading activity. So like any expenses which is relating to this restaurant are gonna be recorded in that income statement because of course why not? Any depreciation on the equipment, literally anything, okay, relating to the restaurant itself. And then if you made a profit, you're gonna put it in the income and expenditure account as an income. And then if you made a loss, you're gonna put it as an expenditure, of course. So look at this. This is an example. As you can see, everything is relating to shop, from shop sales, purchase of goods for resale. You don't need to specify that this is relating to the shop because we only resell goods in the shop. Okay, if you purchase anything else, it's for the club, and for the club we don't resell anything. So yeah, purchase of goods and then shop inventory, shop. So that's the shop income statement. It relates to the shop income statement. You don't put anything that's for the club. Okay, it's really simple. You have your sales and then less cost of sales. You subtract your expenses if you have any, and that's it, your profit. And then it gets transferred to the income and expenditure account. Remember, you have to write profit on shop and not profit for the year. Okay, profit on shop or profit on cafe or profit on anything. You cannot see the shared screen. Are you serious? Should I share it again then? So I'll just share it again. There we go. Hopefully you can see it now. Can you see it now? All right. Please, if there's any issues like this, like maybe my mic is muted or maybe the screen is not shared or anything, then just say it, okay? It's not like I'm gonna, I don't know, crash out or something. It's for your own good and for the good of others. Oh, okay, fair. Thanks for letting me know then. All right, preparation of an income and expenditure account. This is completely the same as your income statement, which means it's going to have the adjustments for the end of the year. It's going to have depreciation. It's going to have, prepaid accruals and stuff. And yeah, you can see that there's all incomes first and then there's all expenditures. That way in our income statement, for a service business, right, we have, first all the incomes and then all the expenses. It's the same for this, okay? And for the debits, for the for the T account format of this, it's also going to be the same. The credit side is whatever increases profit, the debit side is whatever decreases profit. And another thing I want you guys to remember is that when you are talking about non-profit organizations or clubs and societies, you do not use the word profit, you use the word surplus, okay? Surplus for the year, not profit for the year. All right, is that clear? If you use profit, you will not get a mark. I think there is one mark for surplus and there's one mark for the value itself. Okay, so make sure you are not messing things up this way. Okay, all right, come on, I can't twist it. That's kind of sad. Anyways, I don't think it really matters. Whoa, look at that, so cool. looks tough. Anyways, so yeah, that's the income statement. And then for a statement of financial position, everything is similar except that there is no capital. Instead, you use the accumulated fund. This is the previous surpluses, which you mean the profits. Previous profits will accumulate, and then they form the accumulated fund. And the accumulated fund replaces the capital. It consists of any surpluses less any deficits over the years. So accumulated, like they just previous years and everything. It replaces the capital, and this is the income statement for a club. Okay. So as you can see, you have your non-current assets, you have depreciation like normal, you have your current assets like normal, and instead of capital, you just have accumulated fund opening surplus. There is no drawings in this because nobody's really the owner of this. Okay, everybody's just a member, so you can't really have drawings. And yeah, that's it. It's easy to calculate everything here. And then these are liabilities. We can have non-current liabilities as well, of course. And as you can see, we also have this as an asset, and we also have this as a liability, subscriptions received and prepaid and stuff. So, it's just normal. Everything's completely normal. This is just a short comparison of, the things between normal businesses. And yep, you really got Laura, bro. You're like the first number one tough guy for like tough for us. Tough, saying like tough. We should probably write your name here. Please don't mind the handwriting. It's not my handwriting that's bad, it's the stylus, but my handwriting is also bad. Anyway, so profit and loss account section of an income statement, that's the income and expenditure account. So that, yeah, sure. They're not saying income statement entirely because income statement includes trading account as well. Okay. And trading account is for, for service, what is it? For businesses that buy and sell goods. But this is not for businesses that buy and sell goods. Okay. This is just the profit and loss accounts. Okay. So like it's kind of like a service business, income statement of a service business. Profit for the year is surplus, loss for the year is deficit, accumulated fund is capital. Subscriptions is basically income. As we talked before, it is the amount we receive from our members. And the subscriptions account is basically like every income account, like our normal incomes. You have to transfer the income to the income statement. So here you have to transfer the total income to the income and expenditure account. As we have discussed before, incomes or anything that increases the profit comes on the credit side, which would mean that subscriptions do come on the credit side. And if they come on the credit side in the income and expenditure account, then in the subscriptions account, income and expenditure account comes on the debit side because double entry. Anytime we receive payment, we debit our receipts and payments account and we credit the place where we received the money from, in this case, subscriptions. And for that reason, you can see that we have credited our subscriptions account with bank and cash because we received money. And then you can see that we have two balanced CDs and two balanced BDs. That is because one of them is an asset and one of them is a liability. And we can figure out easily because debit side is the assets, credit side is the liabilities. So we can tell that an income being a liability, this is probably prepaid income, not probably, this is prepaid income for sure, because it's on the credit side, so it's a liability. And which income is a liability? Prepaid income is a liability. And then what about assets? Which income is an asset? Accrued income is an asset. Why? Because the customer owes you money. He has taken the service and he's going to pay you eventually. So, yep, that's an asset and that's why it's on the debit side. And then the same thing happens. You receive money, you credit the subscriptions account, and then you transfer it at the end of the year to the income and expenditure account. So it's completely the same as our normal income account, which we did in chapter 11. Calculations of sales and purchases. Again, literally the same thing, just a control account. Since you're calculating sales and purchases, this is the same as chapter 17 incomplete records. And anytime where we made a customer account or anything, because customer accounts are trade receivable accounts. And then accumulated fund is literally assets equals capital plus liabilities, which means accumulated fund is just replaced with capital. The rest stays the same. So here you go. You can calculate accumulated fund assets minus liabilities. Boom, there we go. And yeah, that's the end of this chapter. It's that simple. I don't even think there's a need to do a question for this. And now let's take a 5 minutes break. We are gonna end this break at 3:33, let's say. Any questions so far, guys? How's the explanation been so far? Kind of getting tired, I guess. But yeah, it's fine chapters. The next chapter is nice. Chapter 20 was chapter 20. I forgot what's chapter 20. Is it manufacturing account? I don't like manufacturing account. It's really boring. No, yeah, it's manufacturing account. I don't like manufacturing account. I don't like limited companies. I don't like ratios. All three of these are boring. Like the last three chapters, they're just boring, boring. I want to start accounts for October, November session. Go for it. Literally go for it. Which books do you guys prefer? If you're giving this November, then take the if the keyboard's not working, okay. If you giving this session, then take the how do I just DM her the book? I just DM. Oh, I know her. But who is this? Oh, what? Oh, okay. Anyways, oh no, I can't share it here because it's not gonna let me send because I don't have a metro or something. What's going on? Oh my god, the problem. This is rage bait, bro. Can this just go down? What the heck? Oh my god, I'm just trying to press this side. Okay, that's good. The United States partnership, yes, that is correct. Let me look for it. How did I look for it? I think for accounting is gonna scan. Accounting, perspective, there we go. Okay, just will just keep it there. Otherwise, oh, no, I don't want to do this area. Anyways, oh my god, we have 3 minutes left. No, yep, okay. I think we have to take a good break. A good break is not good without Instagram reels, right? So let's watch some good reels. Yes.
All right.
That's amazing. Is this almost this session is right? Yeah, it's gonna it's working. It's gonna work. It's not, 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 oh my god, I don't want to study. We have 1 minute left. No way.
C'est la Macron est arrivé ce dimanche matin pour une visite. C'est la première fois que le président de la République se déplace en Polynésie française. Emmanuel
That's kind of tough. Okay,
Hey, how is it
guys, we
going?
should probably study.
It's been pretty good
Shut
so
up,
far. Just keeping.
let's create a vaccine for hantavirus.
I can't do that.
Yes,
Developing a.
you can. We have to save humanity.
I get the urgency, but we have to stay
No,
grounded.
no
There's
fluffy language, straight to the point.
Exactly. Vaccine development is a slow, regulated process. We can't just push it out.
Okay, enough.
You've also been on record about English food being better than American. I'm
Hello, guys. There is a phone.
And to the people who spell sorry like this, what do you do with all that extra time in your day? What's it like to have pure freedom? Could you let us time wasters know? And to the people who spell sorry like
I want you to imagine the scene when you meet them in the hereafter.
Okay, it's been 1 extra minute. I think we're gonna start. Okay, that's enough. Anyways, uh, wow. All right, break is over. Let's continue with chapter 19 now. You can come back. Yeah, we're starting, and we are starting now. Okay, so next up we have partnerships. Explain the advantages and disadvantages of forming a partnership. So of course, when you have a partnership, it's different than being alone, right? Because in a partnership, there's more than one owner, so responsibilities are shared, and work the capital is invested by the other partner as well, and there's a bunch of other advantages and disadvantages. Okay. The importance and contents of a partnership agreement. Now, of course, if you're forming a partnership with someone, it doesn't just happen like that, like you're my partner. There is rules and some things you have to follow. So there's a partnership agreement made, like it tells how much profit and stuff will be shared and how much each partner will get and what work each partner has to do and that stuff. Okay. Then we're going to look at some new account called the appropriation account, which is you could say the main part of this chapter. And then, we're going to prepare income statement, appropriation account, statement of financial position. This chapter has a bunch of new things. So yeah, this is going to be worth doing, hopefully. And just a second, I think I'm going to go to another room. Where's my charger? It might be on the table. Okay. Right. To be honest, partnerships is a really fun and easy chapter. Like, you just do enough questions, it's kind of chill. And everything really makes sense. Okay, some people say the corporation account is difficult, but all you have to do is understand some concepts, I guess. It's quite easy. So you share your screen, share, do that again. Let's share it. Okay, I'm pretty sure you guys can see it now, hopefully. And let's get right into it. Did you find people for tuitions? No. No, not really. Okay, anyways, why am I? I'm in session. If you can record my picture. Okay, anyways. All right, let's like jump right into it. A partnership is a business. This is a type of business. We had a sole trader. Everything we studied so far was for sole traders. After this chapter, we have manufacturing businesses. So like, I think we're going to study for accounts for manufacturing businesses. And then after that, we have limited companies. So we're going to study accounts for companies. Okay. So this part is for partnerships, and partnership is where two or more people work together. And then, like, different countries have different rules of how many limits, like how many people can work in a partnership at max. Okay. Professional people and, like, some people operate as a partnership, and family businesses also run as partnerships. New businesses open as partnerships. So, like, like it's easy to expand and stuff. Or sometimes the sole trader forms a partnership so that he can expand more easily. And then a partnership is also formed when a few more, one or more sole traders, like two or more sole traders, agree to bring together their businesses. Like maybe I'm manufacturing tires and then some other person is manufacturing cars. So I go like, "Yo, we should form a partnership. It's going to be good for both of us," like that. Okay. A partnership will maintain double entry records in the same as a sole trader. Everything's similar. There's only one different thing, which is the profit and loss appropriation account. And this basically tells how the profit is distributed between the partners. And this is something that's only related to the partners. Okay, like it's not really related to the business. The business ends at the profit for the year or from the income statement, and then the partners have this account for their own stuff. Okay, well, so yep, these partners have their accounts for their own things, and which is distribution of profits. Anyways, the advantages and disadvantages of a partnership. So when you have a partnership, you can have more money because each partner is going to invest money. You have more knowledge because each partner brings in different things. The responsibilities and workload is shared because each partner is going to do tasks. The risks are shared because like if you make a loss, both of you have to bear the loss. It's not like only you have to, um, take the loss alone like you did have to do in a sole trader. And then discussions can take place before decisions are taken. So you can, like, if you're making or if you were making a wrong decision, your partner could be like, "Yo, that's not really the best thing to do." So yeah, you can kind of save yourself from some stupid mistakes. And the disadvantage is that you have to share profits. Decisions have to be recognized by all partners. For example, if I decide that we should close our business, my partners are going to be like, "Are you stupid?" And I'm going to be like, "No, we should close our business," right? So that's the problem. Partners have to all agree on the decision, and then because of that reason, decisions may take longer to put into effect. Like I'm saying that we should close the business, and then there's some partner who's kind of trying to murder me the next day or something, right? So it's gonna cause problems. Okay, one partner's actions on behalf of the business are binding on all the partners. If I tomorrow decide to close the business and then I just like do something crazy, it's gonna, affect all of the partners. It's not just my fault. It's gonna affect the entire business and, entire partners and everything. So that's kind of bad. And then disagreements can occur and then fights can occur and then so much uncool stuff, right? All partners are responsible for the debts of the business. I don't really know why this is a disadvantage or what this means. If any of you does, then please let me know. But I don't think it really matters for now because we have a bunch of other advantages and disadvantages. All right. Moving on to a partnership agreement is it's a document like a partnership, just something like this. It's just gonna tell who earns what and who does what. It's not really some governmental document or something. I don't know. It might be actually. Anyways, setting out the rules under which the partners will operate the business, including profit sharing agreements. So each partner invests how much capital that's going to be included in the partnership deed, how profits and losses will be shared, if there's any interest on partners' capital. And basically, interest on partners' capital is something we give to the partner so that he is encouraged to invest more capital. Okay, so if you have $1 million capital and you get like 1% interest on it, that's like I don't know about 100,000. You're getting $100,000 or what, $10,000 per year, just like that. Okay, so that's kind of a good thing, and that will encourage you to invest more capital. And then there's also partner salary. So, like for example, if somebody's a partner in the business and then he's also doing the work as an accountant, let's say, so he's gonna get the money which you would normally have to pay an accountant. So yeah. Or if the workload is not being shared equally, then you can pay the salary, because like if one partner is working way too much and the other partner comes at 3 p.m. and goes at 5 p.m., then of course there has to be a difference, right? So someone will get a salary and someone will not. And then there's also partners drawings, because like if you own the business, you can kind of take drawings, right? And then both partners own the business, so both of them can take drawings. But what if I'm a nice guy and then some other partner of mine, he takes drawings every single day and he draws like $2,000 from our business? Like what the heck? That's kind of stupid, right? So we need to have a limit. And if there is a limit, so what limit would it be? And then there's also interest on partners' drawings. So like if there is drawings, then at what rate will there be? This is to discourage drawings. So like, if I take drawings, I'm gonna have to pay back. Oh, that's not a good thing, right? And then interest on partners' loans is to be paid. And if so, then at what rate? So this will encourage partners to, if a partner is paying a loan into the business, he gets an interest. Because like, he could have used that money elsewhere. So this is to kind of encourage him to, take the loan, to give the loan, I mean, and that's gonna give him an interest and stuff. All right, so loan from partners. Partnership may borrow money from one partner if extra finance is required, and then loans from partners are not part of the capital. They're treated just like any other loan because you eventually have to pay it back to the partner, right? This is not exactly, this is going to be repaid. It's not part of the business now. It's just a liability. Interest on loan is a business expense and it's not affected by the amount of profit or loss. And it's just going to be like any other interest on loan is going to come in the income statement. Okay, is interest on loan from a partner is an expense, like it's a business expense, and that's why it's going to go in the income statement. It's not anything related to the partnership, that's why it's not going to go in the appropriation account. Okay, so when you obtain a loan, you're just going to debit bank account because your bank balance increases, and then credit the loan account. Okay, and then when you repay the loan, that's just the opposite. This is just like normal stuff. This is the partnership stuff. The loan account, okay, then when you pay the interest on loan, you're going to debit the interest on loan account because this is an expense, right? And expenses are going to get debited, and then you're going to credit the bank account because you're paying with your bank account. And then if the interest on loan is due, then you're going to have to pay the interest on, you're going to have to debit the interest on loan account because it's an expense. And instead of paying it with cash, you're just crediting the partner's current account, which is, the amount the business owes the partner, basically the capital account in a way. Okay, so it just tells you how much amount the business owes the partner. All right. And if the business has to pay the partner this interest on loan, but the business doesn't have any money, then the business owes the money to the partner X, right? So for that reason, you're just going to put it in their current account, and it's transferred to the debit of the income statement because expenses are on the debit side of the income statement. All right, preparation of a profit and loss appropriation account of a partnership business. Appropriation account is prepared after the income statement because it starts with the profit for the year. Okay, so this is the first thing in the appropriation account. All right, the profit for the year is transferred from the income statement. Any interest on drawings charged to the partner increases the amount available to share. I guess I'll just share it again so that you can see it. Okay, hopefully you can see it now. What time is it? It's almost 4 o'clock. Oh, I have to leave in a bit for a break. So I think once we finish this chapter, we are gonna take a 20 minutes break and then we'll continue after that. All right. Anyway, so we start with the profit for the year, and then any interest on drawings charged to the partner increases the amount available to share. You know what I told about interest on drawings? I said that it's something the partners pay to and we like have them pay this to discourage them taking drawings, right? So the business gets this money, okay? And if the business gets money, it increases the profit, right? Okay. So we start with the profit, okay, and then we add anything that increases the profit, all right, because why not? And then we subtract anything that decreases the profit. Interest on capital is something we pay to the partners, okay, and it reduces the profit, and we pay this to encourage them to invest more and more capital. Well, so since it reduces the profit, we subtract that from our profit. Okay. And then salary, of course, if you're paying salary to a partner, that also reduces your profit. So you subtract that as well. And boom, you get your residual profit or like, the profit that you're supposed to share profit before sharing anything. And then you look at the way you're supposed to share profits. And it says here that they are shared in proportion to the capital invested. The total capital is 60,000. One partner gets 4/2. One partner gets 4/6 and one partner gets 2/6. So that's like 2/3 percent profit, 2/3 profits is for one partner and 1/3 is for the other partner, and they have done the calculation for us. As you can see over here, they did 40,000 divided by 60,000. You can just simplify this and make it 2/3, and that the answer is 12,750. What do you mean? I don't think I'm gonna do charter accounting or anything. I'm just doing my bachelor's right now. Anyways, so yeah, that's literally it. That's the accounting. That's the profit and loss appropriation account. You take the profit for the year. You add anything that increases the profit. You subtract anything that decreases the profit, and then you get to the profit, and then you share the profit based on whatever the question told you to. All right. Now there is ledger accounts that relate to the partner. Each partner has a capital account and the current account. Okay, but there is something more about this. So each member of the partnership has their own capital account file. These usually record permanent increases or decreases in the capital invested by the individual partner. So, like fixed capital accounts or capital accounts which only have the permanent increase or decrease, which means that if I invest money, I will record it. But if I earn money or anything, or like interest on loan or all of these drawings and stuff, none of that will come in the capital account. Only when you invest money, only when a partner invests money, we're going to put that in the capital account. Okay. Everything else will go in the current account. Anything which the partner becomes entitled to, such as interest on capital, interest on loan, salary, or profit share, is credited to this account. It has the same nature as the capital account. Okay. It's because it's a liability to the business. The business has to pay this much money to the partner. Okay. So anything that's on the credit side is something that the business has to pay to the partner. Oh my God. All right, so over here you could have profit share because the business has to pay the profit to the partner. You could have interest on capital because the business has to pay that. Interest on loan, you could have salary, okay, all of these things. And then on the debit side, you're gonna have drawings because the partner owes these to the business. Okay, the partner, yeah, exactly. And then interest on drawings. All right. So that's literally it. That's the current account. And then in the capital account, I'm telling you again and again, you will have absolutely nothing except for like balances, balance BD, balance CD, and you will have the anytime you invest additional capital. Okay, so like even if you have drawings, you don't record them here. You record them in the current account. Okay, so in the capital account, you only record it when you invest more capital. Hopefully that's clear. This is for the only partnership, okay? For normal capital account, you will record everything in the capital account because there is no other account. Only permanent increases and decreases in the capital are entered in a partner's capital account. Anything to which a partner becomes entitled or is charged with during the year is entered in the partner's current account. So all of these is which the partner is entitled to. Like the partner is given this, is given this, is given this, and is given this during the year. So that's goes in the current account. We discussed this. We discussed this. If a partner, yeah, fine, you can just we also discussed this kind of, so I don't really feel like repeating it. Uh, and then if you do not have a current account, okay, if the business does not have a current account, like if they don't maintain current accounts, then in that case, it would mean that they do not have this fixed capital accounts, okay? It would mean that their capital accounts are like normal sole traded capital accounts. And for those capital accounts, you're gonna put everything in the capital account like normal, okay? And then you have drawings accounts, which is just all your drawings, you debit this, and then at the end of the year, you credit this, and then you debit the current account. The way we have it for like, normal businesses where you create a drawings account and then you credit it and then debit the capital account, here you debit the current account instead. This is just an example. And then for a statement of financial position is the same as the sole trader, but for the except for the capital section, okay? So the capital account and current account both have to be shown, and they have to be shown for each partner separately. You don't really need to show the details, you just have to show the closing balance, okay? So look at this, we have capital accounts, 40,000, 20,000. This the question gave us over here. It told us that, this is the balances at the start, and they didn't really invest any capital again. So boom, that's their capital account. And then for the current account, we have the balances we calculated. And then a debit balance is a negative balance because it means over here, what did it say? It means that the business doesn't owe money to the partner. The partner owes money to the business. Okay, so that's kind of a negative balance. Okay, because that's a debit balance, right? But capital is a credit positive thing. So something debit on the capital is negative. You get what I mean? And yep, that gives you the total of this. Sometimes the partners or the business itself may decide to show the entire partnership, show the entire details of the current accounts in the statement of financial position. So instead of preparing the current account like this, they might prepare it within the financial statement of financial position like this. Okay, like this is just more lengthy. Like instead of making a 12 mark statement of financial position, this could make it an 18 mark financial statement. So yeah, that's kind of it's okay. But like it's just I don't know, it's a pain. Okay, that's the end of this chapter. One second, I actually have to check the time for prayer. Yes, I'll just check it like this. It will be 37. Okay, then let's take a 20 minutes break here. I know I'm gonna take in a bunch of breaks, but like the previous break was for lunch, and this time it's for prayer. 20 minutes break. We're gonna continue at uh 4:17. Right now it's 3:57 kind of. So let's see if we're gonna continue at 4:15. Let's just 3:55 to 4:15. And yep, see you guys after the break. No way, that's kind of sad. Your exam is tomorrow, right? I hope they upload the recording before tomorrow, to be honest. I think I'm gonna remind them. Why is the screen doing this? Yeah, exactly. Wednesday, yeah, same thing, same thing. Bro, what is this? Why is there a black, fully black mess? I don't know. Okay, anyways. Right. Yeah, recording for yesterday's session. Is it loading? Okay, well, anyways, go on. No. All right, then I'm gonna see you guys after the break. No, no. All right, then should we start? I don't really think there's many people. We've been doing this for 6 hours. It's crazy. They might want to just bring the different one. Yeah, I know. Right? It's okay, man. Even if we think the entire road is not like everybody's gonna join. Anyways, yeah, there's 3 people. There's 4. Yeah, there's 3 people here. I think that's alright. Maybe I could just play ice bear, maybe, and then maybe the French guy, because he probably cares. And maybe this, this maybe. Yeah, I guess it's book covering. Yeah, I'm doing the entire syllabus. Aim for 80 plus in paper one. Sorry, in paper two, and then aim for like 30 plus in paper one. Um, C plus is enough for A star. If you get 80 plus in paper two, and then if you get like 30 plus in paper one, that's an A star. All right, then should we start chapter 20? We're honestly just gonna like quickly finish these chapters. I don't like them. They're like a lot of theory and stuff, especially chapter 21 and 22. They're so full of theory, and I don't like theory because I'm just gonna be reading, so like there's absolutely no point, you know. Well, the break is over. I came 5 minutes late, and sadly, we're starting even later. But anyways, so yeah, let's begin then, I guess. All right. So we're gonna start manufacturing accounts now, and we have 3 more chapters left: chapter 20, chapter 21, chapter 22. And honestly, these 3 chapters are quite a pain because they're very boring. Manufacturing account is kind of simple. Wholesalers and stuff like that. Okay, so another manufacturing business has normal double entry records, and at the end of the financial year, they make an income statement. And if it's like a partnership manufacturing business, and they also make an appropriation account, and they make a statement of financial position. And then a manufacturing business will also make something new to us, which is called a manufacturing account. So the main purpose of the manufacturing account is to calculate something called the cost of production. That is the entire aim of the manufacturing account. So what exactly is our cost in manufacturing? So we have 4 main elements. The first thing is direct material, then we have direct labor, then we have direct expenses, Then we have factory overheads. Factory overheads is like kind of simple to understand. There's nothing really think about it. You mean IT business, right? Oh, come on, man. Do I look like a business teacher? I mean, accountant. Oh, my keyboard's off. Ah, IGCSE Accounting. IGCSE Accounting. Hosting right now and hosted yesterday. Okay, let's get back right. Let's get back to it. Are you serious? Okay, I have an idea. I think it might be different now. You can probably see the screen. I don't have any ideas, never mind. It's still currently processing, it's taking a long time. Okay, wow, I guess. Part one. How long is my video? I can't even check. I kind of want to know how long it is. Anyways, do you guys like the video? Alright, well, let's get back to our topic. Yeah, well, I hope it stays that way. If it doesn't, maybe try it, leave and rejoin or something. Okay, the first thing is you need to make the goods is the raw material, okay? And this raw material will be different for every business, of course. Like, yeah, it's the examples are given. So that's direct material, okay? And then you have direct labor, is the cost of people who are literally making the product. So the next essential cost is for the wages. Which are like, they can be linked with a product, okay? So for every single product, a manufacturer has to pay a fees, which will be a royalty. That's a direct expense. A manufacturer may have to hire a special piece of equipment for every single product, so that's going to be direct expense. So like, the expense can be linked. So like, for example, if I tell you that for each product I have $1 of this, and I have 100 products, that would mean I have $100 expense. That's what like direct expense is, okay? And then factory overheads of indirect factory expenses are all the other, expenses of the factory. So these three get you the cost of raw material consumed. That's like the first thing you find, and then you do something like for the factory overheads, and then you get cost of production. Anyways, let's go into some more detail. The cost of manufacturing of goods is calculated in the manufacturing account. So the main part is to calculate the cost of manufacturing the goods produced, which is basically cost of production. Now that's kind of sad, man. Like, basically, do opening inventory of raw material, purchase of raw material, carriage inventory of raw material, using inventory of raw material. Okay, you see, it has to be raw material, and the formula is the same as cost of goods sold. This is for the cost of raw material consumed. Okay, this formula is for the cost of raw material consumed. It's the same as your cost of goods sold formula. Then you add direct labor and direct expenses and direct, basically every other direct thing, and you get something called prime cost. Okay, so direct material, which is your cost of raw material consumed, this is from the cost of goods sold similar formula. And then after that, you add any other direct things, so like direct labor and direct expenses. This gives you something called the prime cost. Okay, That's like in the middle somewhere, okay? In the middle of the manufacturing account. Like if you see here, we first start with finding cost of raw materials consumed, which is gonna be same as the cost of goods sold formula. Then we add any direct things, so like we have direct wages, and then we have this as a direct expense, royalties, and then we have our prime cost after adding all the direct things. Okay, so we have direct labor, direct wages, direct labor, direct expenses, and direct labor. The wages is labor here. Okay, direct labor is the fees or the wages for the people who are making the product, and then direct expenses is any direct expenses, which can be directly linked to the product. Cost of production is the prime cost plus the factory overheads, adjusted for any work in progress at the start and at the end. It is the total cost of manufacturing the goods completed. So work in progress is literally, as the name says, it's the goods that are work in progress. They are not completely manufactured, and they're not completely raw materials as well. So, like for example, if you're manufacturing some designer t-shirts or something, then you could be like you have manufactured the plain t-shirts from the fabric, but you don't have any designs on those t-shirts, so those are work in progress. Okay. Anyway, so to find the cost of production, you do prime cost plus factory overheads, which is like all other factory expenses, and then you get to your cost of production. So over here, you can see that this is raw materials. Okay, so this is going to be part of your cost of raw material consumed. This is the first thing in the manufacturing account. Then you have these direct wages. This is also going to be part of your, direct expenses, and then this part is your indirect expense. It's going to come under factory overheads. The factory overheads will be added to the cost of production. Sorry, to the will be added to the prime cost to get to the cost of production. Every single thing in this is added. Okay. So like you first get the cost of raw material consumed. How you get that? You just use the cost of goods sold formula, and then you subtract the closing inventory. But like this, you add the from the final columns, everything is added. Okay. I can't see the screen. Really, guys? Like, what's so wrong with the screen? Anyways, hopefully it works now. All right. Well, so next we have work in progress. It's just partly completed goods, and they have value because you need to get you need to pay or something to get them into their condition. Some material has been used from direct wages, and some everything has been used, so that's why you have to value them. The cost of production, like you have prime cost, you add factory overheads, you have your cost of sorry, you have your factory overheads, then you add your opening work in progress, because this is the inventory, work in progress inventory, which was partly completed at the start of the year, but by the end of the year, it's probably completed. Okay, so you add this, and then you subtract any closing work in progress, which means that the goods which are still incomplete at the end of the year. So you remove them from this year because they are not really they're not part of your cost of production. You put them to the next year. Okay, so that's why you kind of just subtract them. You remove them from this year's manufacturing account because they did not produce. So why cost of production for them? Just remove them. You get what I mean? The same way, how why we subtract closing inventory from our cost of goods sold or from our raw material consumed. Both of cost of goods sold and raw material consumed, they have the same concept. Opening inventory is added and closing inventory is subtracted. So the same way is for work in progress as well, okay? Opening inventory is added and closing inventory is subtracted. Yes, but you said that your exam is in 2026, right? October. So this book works for you as well. You probably have the 23 chapters book, but come on, what's wrong with the screen? Like everybody is saying after a few minutes that they can't see the screen, and then like when I share it works. Is it because of the split screen, this thingy? Is it because they'll have this put on the side? Can that actually be the reason? And what if I just do this? What about now? And I hope it stays that way. All right. Well, so yeah, that's it for the work in progress part. So that's how you calculate the cost of production. Okay. And then you have something called unit cost, which is like how much it costs you to create one unit. So you take your total cost of production divided by the number of units you made, and that's the cost of production per unit. And manufacture all goods. Sometimes it's possible that manufacturing a good is not really so profitable. So they just buy finished good instead. So like they buy from other manufacturers. So yeah, those are called finished goods. So they have cost of sales for them as well. So as you can see, less cost of sales, opening inventory of finished goods, add purchase of finished goods minus closing inventory of finished goods, and then they add the cost of production as well in the cost of sales. Okay. So cost of production is added to the cost of sales. And then anything that's for finished goods is also calculated in cost of sales. Then the total cost of sales is subtracted from the revenue like normal, and then you get your gross profit, and then your other income statements and other expenses here. The profit for the year is calculated in the profit and loss section. It's very similar to the normal business, but expenses relating to the manufacturing process, which were like factory and all of those stuff, have already been entered in the manufacturing account. So now only shop expense or wages for the shop employees and everything like that, rent for the shop, those things are gonna only be included in the income statement, in the profit and loss section over here. Okay, and then of course you're gonna have adjustments as well. And sometimes they're gonna give you in the question, like they're gonna give you the expense. Maybe they'll say like electricity is 4,000, and then they're gonna be like 2/4 of electricity relates to the shop or 1/2. Okay, so then you're gonna have to adjust for that as well. My voice is lagging, really? Shouldn't be lagging. Come on. Anyways, preparation of a statement of financial position. It's completely the same except for inventory. They have three inventories. They have inventory of raw material, inventory of work in progress, and then inventory of the finished goods. Finished goods is what are ready, what is ready. Work in progress is what is partially ready, and then raw materials is what is like just absolutely nothing is done. You just have the materials to build the product someday. Okay. All right, then let's move on to the next chapter. And this is the second last chapter. So let's just take a 5 minutes break before we start this chapter. Meanwhile, I could have a probably look at this chart because it seems interesting. What is let's go. I was given freedom of speech again. Let me share my speech screen. Attending your answers. Literally. Okay. Anyways, I have all right, I guess we'll start now because it's been well over 5 minutes, I guess, though it's still boring. All right. Anyways, so limited companies. You know how we discussed about sole traders, and then we discussed about partnerships, and then we discussed about what's it, manufacturing businesses, right? Now we have something called companies, and we have two types of them. We've got like limited companies, okay? There's public limited companies and there's private limited companies, all right? And they both have some different rules or something like that and different owners and stuff. Okay, So a limited company is a legal entity, has a separate identity from its shareholders. So again, like you know how business entity principle says that, no, okay, goodbye. How business entity principle goes like the owner uh, and the business is different. Well, here the owner is actually the shareholders are the owners, and the business itself are different, and that means that it has a limited liability, whose liability for the company's debts is limited, meaning that if a company suddenly goes bankrupt and gets a fine of $20 million or something, then the shareholders don't really have to pay with their own assets and stuff. They just pay as much as they have in the company, and that's all they need to do. So a new business is formed as a limited company, or a limited company, can be formed if you are a sole trader and then you can, expand it. So basically, you can start as a limited company or you can become a limited company. So one person acting alone can form a limited company, and there's no maximum number of members. The capital is divided into units known as shares. You can issue shares and you can sell them. Okay, so the members or the shareholders of the company are only liable for the debts of the company up to the amount they agree to pay for their shares. So, for example, the company, uh, like I have $1 million shares in the company, and then the company gets a fine of like some $1 million. Okay, so I'll only be liable, like I'll only have to pay the amount of money which I have shares for, which was like $1 million. And the company got a fine for like 200 million. So I don't care about that. I'll only lose what I invested. Okay. They won't take my personal assets. They won't take my car. They won't take my home. They won't take my Bugatti, my Rolex, whatever. They're just going to take the amount of money I have in the company. Since a company can have a large number of members whose liability is limited, a large amount of capital can easily be raised. Okay, so they can have a small value of a share, like $5, $1, $0.5, and then they're gonna sell the shares. Each share is this much, and then people are gonna buy the shares and all of that stuff. And then profits are distributed in the form of dividends. Dividends are sometimes paid during the year, and some usually paid at the end of the year. Okay, so basically the company pays these dividends, and the shareholders get this, and the company pays these dividends from the profit it makes. If there's a loss, the shareholders also account for it because they're literally the owners. Okay, 200,000 shares of $2 each and decides to pay a shareholder dividend of $10. The total amount they have to pay is the total share capital. Over here is $200,000 shares of $2 each. So the total capital would be two times $200,000. So like $400,000 is the share capital, the amount of capital they have in shares, and then 10% of that is gonna be your, the amount you have to pay to the shareholders. Okay, and then amount per share you can just divide that, and you can get the answer. Okay, there's two types of companies. Public limited company, which offers the shares to the public, meaning anybody can buy. So like, you can go and buy Apple shares and stuff. So that's a public limited company. And then a private limited company. So like ChatGPT is actually private limited, which is like they do not sell their shares to the public. Wait, I don't know if ChatGPT is private. I think DeepSeek is private. I'm pretty sure DeepSeek is private because like Chinese, Ching Chong, I don't know. Like last time I checked once in my life, DeepSeek was private. But anyways, so yeah, there's private limited companies. We're doing companies chapter 21. That's quite a fancy way to write 21. But yeah, this is the chapter we are doing. Yep, that's the chapter. Okay. The main benefit of being a member of a limited company is the limited liability. Okay. The limited liability is a very cool thing, and it tells you that you're only liable for the amount that you agree to contribute. It's also good that the company has a separate legal identity. So, like, the like if there's a fine, the company gets the fine, not the shareholders. You don't get anything. You just stay in your home laughing at the company or something. I don't know, being evil, whatever. I don't know. Anyways, apart from very small limited companies, it's not practical for shareholders to be active in the part of running the business. So the board of directors is appointed, and that board of directors actually runs the business, makes decisions, and all of that stuff. Shareholders, they just sit back, they only give their money, and then they stay at home. and they look at the stocks or something. They go like, "Oh, my company shares, oh, my investment, oh, big problem," like that. Yeah, that's pretty much what they do. And if shares are held in a public limited company, it's easy to buy and sell shares because, like, it's public limited. But then if it's private limited, then you can't really sell shares because it's not allowed to offer shares to the public. So you can only sell them to your friends or family members or something. And if you have like companies can have like a lot of people, okay, a lot of people. And then loans can be obtained more easily by a limited company because a limited company is gonna continue forever. If one owner dies, it doesn't really matter. There's like a lot more, okay. But then if a sole trader, the owner dies, there's literally one person. What are you gonna do? Close the business? Okay, dead. Okay, so yeah. So since a company has continuity of existence, the banks and stuff, they're gonna be like, sure, take a lot of money. But the problem is that if you are will also look at it and they're gonna be like, big problem, like that or stuff. I don't know. They're gonna look at your profits or they're gonna look at your um, you know costs and they're gonna decide. They're gonna probably like judge or I don't know whatever. Like it's just not nice to have competitors know your information, right? Okay. Anyways, so now getting to the next part, share capital. There's three types. I was told that this is out of our syllabus, but we'll just go through it because CIE is kind of weird. So issued share capital is the amount of share capital issued to the shareholders. Called up share capital is the amount they request the shareholders to pay, and paid up share capital is the amount they have received from the shareholders. So if I am a company, I issue $1 million shares, and I tell the public to pay like half of the share. So each share is, let's just say, $1. I ask them to pay $0.5 per share, which means that I ask them to pay 500,000 dollars in total. And then I actually receive like some of them go like, haha, no, I will not. And then some of them pay. So I actually receive like maybe 300,000 out of it. And then I ask them to pay like And then you have one other thing, debentures, which is basically like long-term loans kind of, except that it's not with the banks, it's with the public. Okay. Anyways, let's do step by step. Preference shares is kind of as the name implies, they get preference over ordinary shares. So just favoritism because like they're a bit different, but they have a special discipline. Okay, well, anyways, so these get preference over the ordinary shares. They receive a fixed rate of dividend based on the value of the shares. Meanwhile, ordinary shares, they're gonna get the like their dividend is in accordance with the profit. Okay, so it can vary according to the profits of the company. Okay, then the next thing is that the dividend is the same every year, so that's a good thing. Like if you're owning the shares, it's good to know that you're always gonna earn this much money. But then for ordinary shares, you don't really know if you're gonna make a profit or a loss, so it's kind of a risky thing. But what if the company makes a huge profit, then you get huge money. So that's a good thing. All right, if a company is wound up or closed down, any money left after paying outside liabilities is used to pay back the preference shareholders first. Okay. So they're basically given like priority on everything. Okay. So they're going to be paid first if the company is closing. They're going to be paid first. Where is it? Pay back the yeah, exactly. They're going to be paid first if the company is closing, and they're going to also be going to be paid before the dividend is paid to ordinary shareholders. Okay, so even if the company is making a huge loss, these guys are gonna get their money. This is like the safer option. But there is one problem with it. If you're having preference shares, you cannot vote at the shareholders meetings, meaning you cannot decide who's gonna become the board of directors. That's not a good thing. Okay, so because like if you can decide that, then you can, I don't know, make your friend the board of directors for Apple. That's probably a good thing, right? And then you can probably ask him to like send a few iPhones over or something. Anyways, so there's several types of preference shares, and most of these are not really part of the syllabus. I think like I was told that there's like six or seven. I don't know honestly, but there's probably like six or seven types of them. I think so. It's like once my sir was talking about them, I actually want to know now. I'm curious. But that's how many types preference shares are there? Yeah, there we go. Seven types. See, I'm so smart. Anyways, surprised I was right. Okay, but we only need to really know about redeemable and non-redeemable preference shares. Okay, so redeemable preference shares are those which must be bought back by the company at an agreed date and an agreed price. And have they given a non-redeemable preference share? We have not. Okay. Uh, If they are redeemable, the dividend is included as a finance cost in the profit and loss section of the income statement, which means that it's just an expense. Okay. Company will pay back the redeemable preference shares, but the non-redeemable preference shares will stay with the company forever, and they're basically equity, part of the equity. Meanwhile, redeemable is a non-current liability. All right. And then we have ordinary shares, which is like the main shares, the normal shares, and the dividend on them is paid after preference shares has been paid. And then the dividend is gonna depend on the profits we earn. So if you earn a huge profit, you will get a huge dividend, assuming that after preference shares have gotten their money. Okay, and then if there's like bad profits, then you might not even get dividends. But yeah, mm, this may result in very little being returned to the ordinary shareholders if company was short of funds. But the thing is that sometimes you can receive a higher return than your original investment. So it's good, hoping that the company does good. But the good thing is that you're gonna get one vote per share. So like if you bought like 100,000 shares, that's a lot of shares, and you're gonna get 100,000 votes. Okay, in the board of meetings, in the board of directors meetings, and then you can probably make your best friend the CEO or something, and then he's gonna give you a bunch of free stuff, hopefully. Okay, and then you have debentures. This is uh, this is a long-term loan, and then it has a fixed rate of interest, and you have to pay the interest. Of course, it doesn't really matter if you're making a profit or not, just like any normal loan. And it's gonna appear as a finance cost, the interest. You know how we discussed in like I think chapter, I don't know, like at the start in the beginning in the first few sections, yesterday's class, we discussed that in the income statement. Yeah, I think chapter 8. Anyway, so we have the profit from operations, and then we have any interest expenses, and then we have profit for the year. Okay, profit for the year, like the final profit. So in company, in like limited company accounts, you have to first write profit from operations, and then you have profit from interest separately as a finance cost, and then you write profit for the year. Okay, so these finance costs are usually interest on loans. All right. The debenture holders will be repaid before any capital is paid to shareholders. Okay, so these debentures have priority over everyone. Okay, so like even preference shares. So you're gonna first pay debenture interest, and then you're gonna pay preference shares, and then lastly you're gonna pay ordinary shares if there is any money left for them. Okay, and debentures are, of course, not members of the company, and that's why they can't really vote at the shareholders' meetings. They're not members because they're not really investing capital. They're just giving a loan. Okay, so it's just like a bank, except that it's humans instead of a whole bank. And the income statement is exactly the same as it is for a normal company. It's just that finance cost, there's going to be, debenture interest, and there's going to be dividend on the preference shares and on the There's going to be dividend on the redeemable preference shares. For the non-redeemable preference shares, there come in the income statement as an expense, basically. Okay. The venture interest also comes as an expense. All right. Now for the statement of changes in equity. Uh, Okay. So it just tells you what happened to the ordinary share capital, what happened to the non-redeemable preference shares, what happened to the retained earnings. Retained earnings is basically all the profits, like accumulated profit. In equity for that particular year because you're paying it for that year. 1 second. Uh, okay, what matters is when you pay the money, not the same way as income statement. When you, oh my god, right. How to understand 20 to 25 IGCSE accounting formulas in English. So bad. I don't like this chapter. Anyways, any ordinary share dividend or like your take their money out, you know. No, I won't do past papers for chapter 21, bro. I'm not interested. I don't like this chapter that much. And then the directors will recommend an interest or fine. Mm, okay, so at the end of the year, at the end of the year, the directors are gonna be like, "Yo, this is how much money we should pay. We should pay the next year as a dividend." Okay, but this proposed dividend, this is just them suggesting it. Okay, this proposed dividend is not gonna be included in any financial statements or anything. Okay, but you can like say it, like write it down, but you won't record it or anything. They're only included in the statement of charges and equity when they are actually paid. Okay, like how in income statement you record things even when you don't pay them because like accruals and prepayments and the matching principle. Over here you record the amount when you pay it. Okay, because we're talking about changes in equity here. Okay, so of course your equity or your capital will only change when you reduce it. Okay, it's not going to change. Your amount of money you have or the amount of retained earnings you have will not change if you just plan to pay money. Okay, it's only going to change when you pay money. Limited companies do not distribute the whole profit. Even if a limited company wanted to distribute, it would not be possible if there was not enough cash available. Profit is not appropriate for dividend, is carried forward to be the following year. So this leftover profit is gonna, just continue for the next year, and it's gonna be retained earnings, and it comes in the equity and reserves section. Equity is basically capital, but like all types of capital. And then in addition to leaving a balance on retained earnings, companies transfer an amount from the profit for the year, from the retained earnings or profit from the year to the general reserve, all right? This is uh, just another way to store money or something. Usually in the exam, they're going to ask you why we have a general reserve. So the answer to that is kind of for things like, they just for expansions and that kind of stuff. It's kind of stupid because the textbook doesn't really talk about it, and like nobody really talks about it. But then they just randomly throw a question on it, and then you kind of just look at the question. Okay, this is just an example of a statement of changes in equity. You can see we start with the opening balances of all three of them, and the total is this way. And then we have profit for the year. This is increasing our retained earnings. So we add it, and then the dividend paid. If we pay dividend, it reduces our retained earnings. So we subtract it. If we pay dividend again, it reduces our retained earnings. We transfer to general reserve. So our retained earnings reduce and our general reserve increases. Okay, so there is no net effect on the total. All right. And for the statement of physical equity, when you total this side, it's gonna equal to this, and when you total this side, it's gonna equal to this. You have like this. These are the all types of things we have in the company, in the company's equity. So this is all the money the company has, basically, kind of like, you get what I mean. All right, that's it for this chapter. Let's see how much we understood and do this MCQ over here. I want you guys to answer this question, please. Come on, bro. Somebody answer question number two. Which items may appear in this table of changes in equity? Debenture interest. Is this part of capital? Is this part of equity? It's not part of equity. Ordinary share dividend paid. Okay, sounds cool. Ordinary share dividend proposed. They're just talking about giving it. They're not actually paying. Transfer to general reserve. Haven't learned that lesson yet, bro. Well, what was I teaching then? I teach. Okay, man. Like, what do you mean I haven't learned the lesson in the school yet, bro? Come on, man. Like, was my teaching that bad? Anyways, the answer is gonna be, where is it? Okay, this debenture interest is not actually your, what do you call it? Oh, wait, yeah, please, you guys answer. I don't feel like answering. D. Okay, let's see. Transfer to general reserve is correct. Order schedule is correct. And the answer D is correct. Amazing. So this is proposed. It's not actually paid. So we do not record it until it is paid. And then this is debenture interest. It comes in the income statement as a finance cost because debentures are not really your, it's not part of equity. It's just a non-current liability. Okay, let's look at this one then. Which items are included in the equity section of the statement financial position of a limited company? One, two. That's all. Three and four. That's the answer. Okay, there we go. Then, are you there? Or like, okay, so we should do it, right? How did that happen? Okay, let's go. But thank you very much for supporting Trust. Like, if there was nobody, I would lose hope and then I would probably stop. Anyways, all right. So I think I'm gonna clean this up first. Let's do this like that. There we go. All right. So you know how once you prepare financial statements, you can kind of compare and stuff with other businesses. But like that's not all, okay? Because it doesn't tell you everything you need to know, and it's kind of difficult to compare and understand. Okay. So we need some ratios. We use some values and some formulas and stuff to give us a kind of value or like a direct answer to tell us what is what and how well we are performing instead of every percent or every time you're having to assess the entire financial statement. Okay, so these things are called ratios and it's kind of like analysis and interpretation. Okay, so we have like these like 8 ratios or something, I don't know. And there's a lot of theory on this, on these questions and topics. Like with the textbook, there's a lot of theory, but I won't really be going through all of it. I'll only explain every single ratio and I'll explain its benefit. And yep, that's quite it. That's quite about it. Okay, so we have analysis and interpretation. Analysis is just a detailed examination, and then interpretation, the results of the analysis are then interpreted in order to assess the performance of the business. The interpretation will be comparing the results with other businesses or comparing with your own business for previous years. And to help the comparison, in a work out in a nice way, you use accounting ratios because that's kind of easier to understand. It's a general term which involves calculations in the form of ratios. We usually have ratios, we have percentages, and we have time periods. Time periods as in like days, weeks, months, okay? So ratios are usually in two groups. We have profitability ratios and we have liquidity ratios. As the name says, profitability ratios tell you how much profit you're making, okay? And then liquidity ratios tell you how liquid your assets and stuff are. Now, what does liquid mean? Liquid means like how close it is to becoming cash, okay? All right, let's start with the first thing. Working capital. We need to know what working capital is. This is current assets minus current liabilities, okay? Current assets minus current liabilities, that is working capital. And another name for working capital is net current assets. All right, so net current assets is going to tell you how much money you have and how much money you have to pay other things and stuff, okay? Your current assets is going to tell you how much money you have and how much inventory you have. And then your current liabilities is going to tell you how much money you have to pay others and stuff, right? So the difference between those two is how much money you actually have, how much money is yours, all right? And the remaining is for your liabilities. You get it? So when you subtract your liabilities from what you actually have, it tells you what is yours from what you have, okay? So yeah, that's kind of about it. And then capital owned is the amount the business owes to the owners, and capital employed is the total funds in the business. Okay, the total funds which are being used by the business. Now, how do you get it? It's not just the capital you invested. There's also non-current liabilities. Okay, so capital employed has two formulas actually. One is calculate this is by doing what is it? Capital, which is equity or capital plus non-current liabilities, all right, all of your non-current liabilities. And the next way is to do non-current assets plus working capital, all right. Now, what did we say? Working capital has another name as well. So you can also say non-current assets plus net current assets. Net current assets and working capital are the same thing, okay? And to like kind of expand this, you can go like non-current assets plus current assets minus current liabilities, because current assets minus current liabilities is working capital. So it's the same thing. All right, then moving on, we go to, we've done with capital employed. Return on capital employed, and this ratio tells you how much profit you're making per $100 of capital. Okay, so it tells you the amount of profit earned for every $100 used in the business. Now, how do you calculate it? By the way, every $100 because it's expressed in a percentage. Okay, so you start with the profit for the year before interest. Okay, so profit before interest, we call it profit from operations. All right, but for your understanding, it's fine. It's okay to use profit for the year before interest, and then you divide it by capital employed, which we just found, understood over here. So profit for the year before interest divided by the capital employed multiplied by 100. This gives you the amount of profit you make per $100. And yeah, the higher the return, the more efficiently the capital is being employed in the business. Of course, if you're a businessman, you want your profits to be as high as possible, right? So you want your returns to be as high as possible. Are you guys serious? Yeah, okay, well, it works now, right? Hello there, welcome here. We're on the last chapter though, but like, well, it's good you came at least now. Well, can you see the screen now? Should I reshare it? Stop share, reshare. Surely you can see it now. I hope. Can you share your P2? I don't know where it is, bro. I think I changed my phones and then I lost it, I think. I'll be on my look for it. Alright. How to understand by watching my videos, lol. Okay. You're dipping. No. Okay, well, anyways. Are you typing something? Is the screen moving? Yeah, sure, sure, sure. All right. So that's return on capital employed. Okay. The next thing is gross margin. This is the margin we did in incomplete records like today only just a while ago. Okay. So we have gross profit over revenue, and we already know how to calculate this and stuff. And there is no markup. There is no like uh, there is gross margin and then there's profit margin as well. Okay. So this is gross profit. This tells you the amount of gross profit earned per $100 of sales. Okay. And then you have profit margin. By the way, like this is just telling you how to improve and how to like uh, what affects it and all of that stuff. Okay, anyways, well, so the profit margin is similar. Instead of using gross profit, you use profit for the year. Okay, profit for the year divided by the total revenue, and this gives you the number of dollars per like a number of profit per $100 of revenue. Okay, that's good that it works. And then you remember to express these as percentages because if you do not write percentage, you will lose 1 mark. Okay. And the next thing we have is liquidity ratios. This is just going to tell you how liquid your assets and stuff is. Okay. So we have the first ratio, which is current assets ratio current liabilities, or you can just do like current assets divided by current liabilities, and then but just remember to express your answer as a ratio of 1, okay? Because if you do not write it like this, you will lose 1 mark, all right? So the formula for current ratio is current assets divided by current liabilities, and then you have I guess they don't. Yeah, I guess it's not sure. Anyways, all right. So basically, where is it? Uh, there we are. Okay, so the reason we subtract inventory is because it's not very liquid, okay? It's not very close to cash. It is 2 steps away from being cash. It's 2 stages away from being cash. You have to first sell the inventory, and then you're gonna have to collect the money from the from the credit customers, okay? So that's why you remove inventory, and then you get your assets, which is gonna be like your money and your trade receivables and your cash and your bank in compared to your liabilities. Okay. Now a standard ratio is 0.7 to 0.1, but like the size and types of the business also matters. A one-on-one ratio indicates that you need to only like if it's 1:1, it means that you only have enough money to be able to pay your liabilities. You don't have enough money to do anything new. You don't have any money, enough money to maybe invest somewhere else or maybe versions and stuff. I don't really even try to find newer papers when they come out because like I'm no longer IGCSE and stuff. So like I don't know. I'm just teaching this because it's fun to teach and because I like want to. I give tuition, so I probably want students for that. And then it's also that because like people have exams a few days and schools don't really help. I don't know. Like people usually don't understand how their teachers explain, and I was like that too. So it's nice to have someone explain how or why things happen the way they do. So yeah, I'm just doing that because cool, right? Then we had the rate of inventory turnover. This is something we did in Incomplete Records, chapter 17. It's just cost of sales over average inventory, and this tells you the number of times you are, completely selling your inventory in a year or in a period, whatever. Usually a year though. Okay. And then you can also check it in the number of days by just doing multiplying it by 365. You can check it by, yeah, it's usually the number of days. All right, and then you have trade receivables turnover. This is going to tell you how long your trade receivable customers, how long your credited customers are taking to pay their accounts. So they do trade receivable, you do trade receivable divided by total credit sales, like your credit sales, right? Because you can't have your total sales because cash sales are included too. So you only choose credit sales and you do trade receivables divided by credit sales, multiply by 365 if you want it for, days, because there's 365 days in a year, and then multiply by 52 if you want it for weeks, and multiply by 12 if you want it for months. Usually you're gonna have to, use days because like you don't want your trade receivables taking weeks or months, right? Because that's kind of too much. So maybe you might use weeks as well, but days is usually the like the first choice or something. And then you have trade payables turnover, which is pretty much the same thing, except that it's for your credit suppliers and so credit purchases, So trade payables over credit purchases, and then the same concept. If you want for days or weeks or months, you divide it accordingly. You multiply it accordingly. Sorry. And this is just them showing how how this is then comparing the ratios for two firms. So like this firm has this much, this firm has this much, and then they're commenting on every single ratio and for both businesses, and then they're justifying what is good and what is bad and stuff. But I really do not have the time or energy, or I don't love theory that much to be able to or to wish to explain this stuff. Okay. And even if you guys think that this is way too much, it's kind of important, but it's not like so important that you need to really memorize it. But you need to go through it, especially this part, okay? Like this part and above, the reasons and the advantages and disadvantages and the points of relating to the ratios, you need to know them. But this textbook is better than yours. But this textbook is like really lengthy, right? So I'm gonna share some notes over here. You guys gonna go to the bins and yep, you can use this. This is exactly the notes I'm talking about. And found it if anyone else needs. All right, well, yep, that's the end of this chapter, by the way. Thank you guys for attending, and I hope you all have a good day. Let me know how your exams go, and yep, good luck for all of those exams. Make sure you destroy it and get an A star. And in case you do not get an A star, make sure you I don't know, but just get an A star now. Come on, it's not that difficult, right? Okay, 17th, we had the pleasure of having one of our subject teachers. Oh my God, they called me a teacher and not a helper. Wow. Host a study session for IGCSE Accounting, in which she, bro, I'm a male, okay, gave an in-depth run-through of IGCSE Accounting syllabus. The recording has been uploaded, and like and subscribe. The subject helpers are welcome to study and teach and whatever. Pretty cool. Let's check the video. How long is it? Only 4.5 Business with
Yes.
these. hours. You can
Yes.
measure Amazing the profile progress of your picture, business bro. by comparing these financial
What's the
statements with the
maximum
previous years or with other
quality?
businesses. Okay. And then you have accounting ratios
Hey
as
man,
well,
come on,
which
this
is like
doesn't
the
look like good quality
accounting
to be
part,
honest.
which is on the bookkeeping. The accountant is gonna come and do some ratio.
Let's just open this here, this here. You don't have to call me sir, bro. It's all right. We're probably the same age. You might as well be older than me or something. I'm just 17. It's chill. No problem, guys. Have a good day, y'all. Have fun. And the recording for session one has been uploaded.
business with these.
Oh, okay. I
You
think
can
it's
measure your
not
progress
that
of your
bad,
business
right?
by comparing these financial statements with the previous years or with other
Okay,
business.
that's fine. Though what is this? The recording is not like it's focused on the audience and it's showing the chat.
Business pays for goods
Oh,
to
okay,
be
never
delivered
mind.
to the customer's devices.
Thanks for the session. Waiting for the session to be loaded. Yeah, man, don't worry. Thank you guys for attending, to be honest. What yapping, man? Come on. Like, I want you guys to talk and ask questions and yap and stuff, because when I'm explaining or when I'm teaching and there's nobody talking or asking questions or like doing anything, I just feel like I'm teaching nobody, and then it just feels sad, and then I feel like I don't want to teach. And then I go like, is this really worth it? Let's khatam. All right then, yep. अब तो बस मैं टाइम पास कर रहा हूँ. All right. Anyways, yeah, GG. I guess I'll leave now. And then I don't know, maybe I'll sleep or something. So I can't really sleep now. This is sad. Okay, well, anyways, thank you all for attending. You all for attending and focusing, hopefully. Goodbye. Ace the exam, guys. I believe in you. We are ending. We are done. We are 22 chapters. Oh, crazy. We started at 10 a.m. 10 to 11, 12, 1, 2, 3, wait, wait, 10 to 11, 12, 1, 2, 3, 4, 5. Oh, 7 hours. That's a lot of hours. Anyways, yep, it's hopefully worth it. Okay, then. Uh, okay. Yeah, I know about the exam being on Wednesday.